Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith. We got some breaking news out on inflation, CPI coming out right now, and taking a look at these numbers here and the headline numbers month over month. The increase was 0.3%. When you take a look at that headline number year over year, that coming in line with expectations at 3.4%. The core the core year-over-year number that we are getting is 3.6%, and the core month-over-month that we are also getting here is 0.3% move here to the upside. So when you take all of that into account here, mostly in line with expectations, you did see a little bit of a better print than we had been expecting on that headline month-over-month number here, the increase of a 0.3%. What we're expecting to see was an increase of 0.4%, so a bit softer than what we had been expecting here. And taking a look at the futures reaction right now, it does look like looking at gains here, and that was largely expecting heading in to this print here, because remember, Brad, the last 3 CPI reports that we've gotten have actually surprised to the upside.
Yeah, I'm taking a look at some of the indexes here, and should come as no surprise. Shelter, yeah. The index for shelter rose in April, as did the index for gasoline, and combined those two indexes contributing for over 70% of the monthly increase in the index for all items. And energy, that rose by about 1.1% over the month. It was interesting, food index, as we continue to track what you're paying in the aisles in the grocery stores, whether you're a Kroger person or a Walmart person out there, you're spending just a little bit more. However, we're taking a look at the year over year versus the month over month, unchanged in April. The food at home index, that actually declined by about 0.2%. So a little bit of easing there. However, taking a look at the food away from home index, that rose about 0.3% over the month.
Yeah, and let's take a look at the market's reaction here. Again, we are adding to those gains, not necessarily a huge surprise. We would expect that because these numbers largely coming in line with expectations. And when you take a look at that, it's down in the side of your screen there. You've got S&P futures now trading to the upside, adding to those earlier gains. You got the Nasdaq futures also pointing to the upside here, as well as the Dow. So again, looking at some gains there. And then when you take a look and flip it over to the bond market, some of the action that we are seeing there, we are seeing some pressure here on rates. We've got yields moving lower here, and obviously that is in reaction to that inline print here. So maybe reassuring the street that a rate cut could be on the table before the end of the year.
Absolutely. We're going to take a look at that FOMC probability in a moment. But first, let's go to the Wi-Fi Interactive Yahoo Finances. Jared Blickery standing by with a check on how the markets are doing. Hey, Jared.
Hey, Brad, we are seeing a risk-on reaction here. S&P 500 futures. By the way, we are pretty close to a record high. Might even achieve that on the open, so we'll be standing pat for that. But here's the S&P 500 futures up 0.6%. Nasdaq going to look pretty similar here, up a little bit more, 68 basis points. And the Dow is up 177 points, or just under 0.5% in the pre-market. And as we've been discussing, guess what? Rates are going down, but that means that the Treasury notes and the futures, which is what we're looking at here, those are going up. But we know when rates go down, as they are now, that can be a tailwind for stocks and certain asset classes more than others. Here's the 10-year, very similar situation. And let's get over to some futures action right now. I'm going to cover more of that on the open, especially copper and cocoa. But here's gold. You can see that exceeding its prior 4 a.m., 5 a.m. high right there. We'll take a look at copper. Copper has been surging to record highs very recently. So we're seeing copper up, but not really much of a movement off of this report here. And then we want to track Bitcoin, because sometimes Bitcoin can have very big reactions as well. And here we go. We got Bitcoin surging higher. So sometimes Bitcoin is that levered bet on Fed and just kind of that fringe liquidity that we've been looking at. And we'll also be talking about meme stocks later on in the show. Speaking of fringe liquidity, just want to check on the sector action in the pre-market here. Real estate and utilities, number 1 and number 2. So those have been 2 sectors that are high flying, very interest rate sensitive, and they are benefiting the most from this. I should say tech is in 3rd place today.
All right, Jared, thanks so much. We also want to bring up retail sales. We also got that print out right at 8:30. And you talk about this reaction that we're seeing in the market. Maybe some of that, or maybe more than some of that, has to do with these retail sales numbers that we are getting, pointed to some cooling here in consumer spending. Retail sales advancing on a month-over-month basis, that was flat. The expectation was for a move to the upside of 0.4%. Also, the prior reading that we're getting out revised lower here, down to 0.6%. When you take out ex-auto, that month-over-month increases 0.2%, essentially in line with expectations. Ex-auto and gas, it actually declined 0.1%. That was a move lower, obviously, and coming in below what the street was looking for. And that retail sales control group, we know that's a component there for GDP. That's actually coming in a lighter than expected here, a decline of 0.3%. So when you see some relief, it looks like, in the market. So I think it is that CPI print, but then a lot of that has to do with this weaker than expected retail sales number as well.
Yeah, really interesting. Some of the areas that you're seeing declines versus continued or outsized advances right now, the declines actually continuing to come in the form of furniture and home furnishing stores. That should come as no surprise here. That's continued to decline year over year by about 8% here, 8.4 to be exact there. But one of the areas that we're also seeing a bit of a comeback here, and we talked about some of the areas that over time had taken on the biggest hit. It was what we just mentioned in furniture and home furnishing stores. It was also electronics. However, that's actually starting to see a little bit of a comeback there. That's up by about 1.5% month over month here. And then additionally, taking a look at one of the other areas, apparel, that had continued to get hit hard here, as well as the sporting goods and hobby and musical instruments. Sporting goods continuing to move lower, so keep a close eye on companies like Dick's Sporting Goods or Hibbett. We'll see how those stocks move here as we get into today's session. And year over year, that's actually down by about 4.7%. And then just lastly here, some of the general merchandise stores. You think about those department stores as well within this. Slight increase month over month, but still down year over year by about 1.2%. So keep a close eye on Nordstrom, Macy's, seeing how they trade on the back of a report like this today. Also, everyone, consumer prices rose 0.3% in April, in line with expectations. Futures jumping on the print. And for more on the latest inflation data, we're joined by Gregory Dacko, who is the EY chief economist, and Peter Chur, who is the Academy Securities head of macro strategy. Great to have you both here with us. Just want to get broad strokes reaction. Greg, I'll start with you.
Well, I think generally speaking, inflation is moving in the right direction. We had this softer than expected headline CPI print. Core was in line with expectations. If you look at the underlying inflationary dynamics, they still point towards disinflation. It's a little bit slower than we had anticipated at the start of the year, but that momentum is still in place. You're still seeing the fundamentals of slower consumer spending growth that is adding to disinflationary pressures. And I think this recent retail sales report, while not alarming, does show that consumers are exercising a little bit more scrutiny. That's generally disinflationary. I think that disinflation momentum will continue. We'll probably hit an inflation plateau over the summer and into the fall, but nonetheless, the underlying disinflationary forces are still very much in play.
Peter, what do you think? We have the futures reaction right now. We are certainly starting to see a surge here on the heels of this print that we got on CPI, also that retail sales number. But what do you think this tells us just about how worried investors are about this possible reacceleration of inflation and the fact that this report actually starting to ease maybe some of those concerns?
Yeah, I actually think we're going to come into a very confusing stage where people have been hoping for signs of disinflation. We're getting it, right? We're seeing the economy slow down a little bit. And so far, we've been cheering that on the bond side, which makes sense. So far, equities, though, have also been rallying as bond yields go lower. I think that's about to change as people start digging into the economic realities where a lot of the economic data is getting weaker. I like to look at the City Economic Surprise Index. It's down a lot. And data after data point is weaker, like retail sales. So I think part of the bond yield rally today is more attributable to that than the CPI. And equities following that may turn out to be a mistake where equities realize, whoa, we may have gone and jumped from no landing back to bumpy landing.
So then what does that tell us then, Peter, about what that action could look like then over the next several trading days?
So I think bond yields stay roughly where they are. Maybe they go a little bit lower. Maybe they start creeping higher. We've had this 430 to 450 range for the last week or two, and that's been working pretty well on 10 years. So I think that settles in. I think equities kind of go through this, rally that we're getting. Then people start looking around, who buys it for me? Who buys next? Then they start worrying about Nvidia earnings. And I think you see stocks roll over a little bit. It's not going to be a hard rollover coming into Nvidia, but I think you see that start slowing down as people question the state of the economy. And the only last, kind of wrench to throw into this whole equation is you are starting to see some commodity inflation, right? Everyone's talking about copper, things like that. Do you start running into this risk of stagflation? It's not my base case, and I would have completely dismissed it about a month ago. I don't think we can dismiss it anymore, especially after we added some new tariffs yesterday.
Greg, I'm not going to ask for your comments on Nvidia, though, if you want to talk about generative AI, which I know we have before, you're more than welcome. I'll put this question to you, though. One of the huge things that we question coming into this report is if this was going to be a report that ultimately changed the mind of the Fed one way or the other going into either September, which is still the earliest case for which we could see a cut, or December. Does this change their calculus tremendously?
Well, I think it does influence how markets are looking at the Fed's reaction function. And that, unfortunately, has been quite exuberant over the course of the past few months. We've seen every single data release be over-analyzed in terms of the underlying trend of inflation, of the labor market. I think Peter is spot on when he describes the downside risks to the economy. The economy is slowing, the labor market is slowing, job growth is moderating. That will put downward pressure on income for households and lead them to exercise more scrutiny with their purchases, which generally tends to be disinflationary. Energy prices aside, we have continued to see disinflationary forces in terms of slower final demand, in terms of reduced markups. We saw that in yesterday's PPI data, in terms of moderating wage growth, and still moderating rent inflation pass-through into CPI. Combine all those elements, that would lead you to believe that the Fed will start easing monetary policy in the coming months. When it does so is not that clear yet because the Fed and Fed policymakers are a little bit more concerned about the risk of inflation reaccelerating, as Peter highlighted. But we continue to believe that disinflationary forces are in play, and with some softening of the labor market, I still think a July rate cut is a possibility in this type of environment.
Peter, what do you think? What in terms of the Fed timing and what that you think that most likely looks like?
Yeah, I've been kind of stuck that we'll get two this year, June, July. I think it's probably more likely July and maybe December. But I do think Powell, as he said yesterday, he is looking for an excuse to cut. He is going to want to cut. And he really doesn't want to cut in September, right? That'll be kind of peak election talk. So I think he wants to get at least one done this summer. So I'd agree that I think, July rate cut should be on the table and probably one more this year. He gets two. The data probably supports that. We would need something strange. But that's why I also think equities are going to start looking and saying, hey, we're starting to cut because of the real demand following and weakness in the economy, not just because of disinflation. And that's where I think equities are going to struggle a little bit more than the bond market.
Peter, I want to bring up a point that you mentioned a couple of minutes ago, and that was this risk here of stagflation. Talk to us a little bit more about the risk that really poses here to the market, and then the tariff tie-in, just why that raises that risk that maybe we could see stagflation.
And I would say a lot of this comes from Academy Securities. I work with 22 retired generals and admirals, so we spend a lot of time thinking about the geopolitical risks. And across the world, commodity risk is high. Venezuela's making some noise again, right? We're depending on them. You still have nothing resolved in the Middle East. Does Putin do something to disrupt oil or commodity flows coming into the election? Because presumably Putin would like Trump to win and high inflation would be bad. And in the past month, we've seen the U.S. kind of being forced to exit parts or countries within Africa, North Africa, right? So I see commodity risk there globally. I do think China is going to respond to the tariffs. That's going to put some inflation pressure back into the system. So it's not going to show up in the next 2 or 3 months, but I think in the next 3 to 6 months, there is going to be some commodity risk, some sort of shock potential there. And I do think China will respond to the tariffs negatively, and that will reinsert inflation pressure just as the economy is slowing. So that's where I feel like stagflation is a low probability event, but I would knock it from a 0 to maybe a 5 to 10% chance in the next 6 months.
Gregory Dacko, who is the EY chief economist, and Peter Chur, Academy Securities head of macro strategy. Thanks both for joining us here to break down these numbers this morning. Appreciate it.
Thanks for having me.
Coming up, everyone, we dive even deeper into that March CPI print coming in line with expectations on the year-over-year futures moving higher on the news, and we'll be right back. Futures climbing higher after April's inflation print comes in line with expectations, and we're taking a deeper dive into three sectors that have been hit by sticky inflation: food, shelter, and transportation. And we've got team coverage to break it all down with Yahoo Finance's Brooke DePalma, Madison Mills, and Jennifer Schonberger standing by. Brooke, let's start with you here in studio. You're watching food as consumers are continuing to monitor grocery prices here.
Yeah, that's right. Americans are still feeling the impact of those higher food prices in April. They still felt it in April, rather. Overall food prices jumped 2.2% last month, but was unchanged compared to the month before. Now, the cost of groceries alone increased 1.1% compared to a year ago, but did see a slight decrease compared to the month prior, down 0.2%. Now, some of the ingredients that saw the highest jump in inflation last month include flour and prepared mixes, up 3.2%, lettuce up 2.3%, and butter up 4.3%. Now, this report comes as a group of 40 lawmakers led by Senator Elizabeth Warren did call on President Joe Biden to investigate grocery store chains for price manipulation. Now, in the letter, she urged the president to take action to lower food costs. And what drove overall food prices last month was really actually not just grocery prices, but what we saw of food away from home. Labor inflation and higher commodity costs did continue to persist. The cost to dine out at restaurants jumped last month, up 4.1% year over year and up 0.3% month over month. And we've heard from companies like McDonald's and Starbucks, they're starting to feel consumers push back because of these higher prices. Both those companies posted sales growth that missed Wall Street's expectations. Another sector, I know, Maddie, you're watching, shelter, that contributes to just over a third of the CPI print. I know Main Street and Wall Street are watching out for that. Maddie, what did you see in the report?
That's exactly right, Brooke. It's really interesting because we're seeing that 70% of this print can come down to the contributions that we saw from just shelter and gas. So taking a look at some of the headline numbers that we got from that particular part of this index, shelter up 0.4%. We've seen that over the past 3 months now, so just in line with what we've been seeing. But that brings the year-over-year contribution of shelter up to 5.5%. Previously, we were at 5.7%, so we are seeing a little bit of progress there. The shelter picture of inflation becoming increasingly important as a gauge of whether or not the Federal Reserve's rate hike cycle is having an impact on the current state of inflation, particularly when you consider that shelter alone contributes to 50% of the overall CPI picture, and it's about a 36% weighting in the CPI. So when you are looking at what the Federal Reserve looks at, they're able to take out some of that data, including owner's equivalent rent, for example. So that picture, the super core number that we look at, a little bit better when it comes to looking at the progress the Federal Reserve has had. But Jen, I know that you're watching transportation and services costs. What are you seeing there?
Hey, Manny. Yeah, that's right. Transportation costs still adding quite a bit in this last report, up 0.9% month over month, though a little bit better than the month before, which was up 1.5%. If we look at that year over year, it was up 11%. But I really want to call attention to services, because that is something that the Fed looks at closely when they look at the different components of inflation. And that clocked in at 5.3% for the month of April, holding the same level as March. So on its face, you could think, oh, well, services is still looking sticky. That's not great for the Fed. But if we take a step back and sort of look at the glass half full, you'll see that, okay, fine, it's at 5.3%, but it's holding at 5.3%. If you look back at the beginning of the year, it started at 4.9% in January, going up to 5.3%. We saw sticky inflation for the first quarter, so perhaps maybe it's leveling off before it begins to turn down again. Of course, we will need to see more months of this to see if that is indeed the case. If you look at services excluding shelter, that looks a little bit better at 4.9%. Overall, this report looking good for the Fed. Is it enough to change the calculus at this point? No, I don't think so. Jana?
All right, Jen, Brooke, and Madison, thanks so much to all three of you for breaking down what we have seen in different parts of this report. Let's talk about this move higher that we are seeing here because futures are moving to the upside. CPI print coming in line with expectations. The data coming after another report pointed to stickier inflation. That was PPI out yesterday. For April, it rose at 0.5%, which was more than we had expected. So let's talk about what this means for the path forward. For that, we want to bring in Stephen Juneau, Bank of America Securities, a U.S. economist. Stephen, it's good to see you here. So when you take a look at this print that we got in CPI, that was essentially very close to consensus. We had a weaker than expected retail sales print. I'm curious what your first takes are at these two prints and what it ultimately tells us about the state of the economy right now.
Well, I think your previous panel summarized it perfectly. You know, it's a step in the right direction. We've seen a step down in inflation from the first quarter. That was a very kind of ugly first quarter. We saw a torrid pace of inflation growth. But now we get kind of this step down. But is it really enough for the Fed to get too excited about? Probably not yet. But it is kind of confirmation that 1Q was maybe a little bit anomalous, a little bit statistical noise. We do think January was boosted for some statistical reasons, and now maybe you're seeing a bit of a slowdown. Then you layer on top, is the Fed in restrictive territory? Well, retail sales at least tells you that maybe they are starting to see that more and more. Now, this is just really capturing the good side of the economy. It also probably reflects a lot of payback from a very strong print last month because you did see non-store retailers pull back after a very strong March. So maybe a little bit of payback there. You kind of want to look and smooth through the monthly profile there and see that on average, you know, the consumer is still in good shape. We're still spending, but are we starting to see durable goods spending maybe pull back a little bit because of higher rates? I think maybe you're starting to see a little bit more evidence, and the Fed can be a little bit more confident they're in restrictive territory when looking at retail sales, and they can be a little bit more confident that inflation isn't running away from them when they look at the CPI data.
Yeah, Stephen, one of the things that came up in our panel just a few minutes ago was when we could see a plateau in inflation, and one of the comments that we received was over the summer we could see that. From your estimation, does this data kind of point us in that direction, and what would you be looking for?
So we are, I mean, broadly speaking, when we look at the Fed's preferred measure of inflation, so PC inflation, we're forecasting progress on a sequential basis. So that 1Q data is going to look a little bit outside the broader scheme. We're going to get better data moving forward. But when you look at the year-over-year rate because of unfavorable base effects, well, we think PC inflation is really going to stagnate this year, kind of across the board. So we have PC inflation ending the year, the core PC inflation, ending the year at 2.9%, which is roughly unchanged from the end of last year. So we do think we're in this year where the last mile is just that much harder than what we saw last year. It's more and more about services inflation, and that's going to take some time to bring down. Some of that is due to housing just being sticky, being inertial, but we have seen progress there. It's just a matter about when, not if, that comes down because market rents have certainly normalized.
Yeah, Stephen, talk to me a little bit more about that and just what you expect that timeline to look like in that part of the CPI print for more stabilization.
So for that, I mean, I would say we're looking for firmness over the next few months. Typically, the best forecast of this is for the next month is the previous month. That's kind of what you find out just statistically. It's not a very insightful argument. But then when you look at the broader trajectory, I think the second half of the year is probably where you start to see a little bit better improvement. So instead of 0.4s on shelter, on OER, on rent, maybe you're in the 0.3 region. So you're getting kind of that step in the right direction. And that's going to be a source of relief for the Fed because they are continuing to look for that to happen.
And just lastly, while we have you here, in an exclusive interview with Yahoo Finance, President Biden told our own Brian Sazi about wage growth and how that is affecting inflation here. Just want to play this clip and get your reaction.
I think inflation has gone slightly up, but the fact is that I think people are just uncertain. And that's why we got to be steady, stay the course.
Just want to get your reaction there, Stephen, and what this all means in terms of the trickle through to inflation.
Yeah, so we have seen kind of real wage growth, real income growth. That purchasing power has started to really recover after being shocked downwards during kind of the past really more than the past 2 years, but during the pandemic years where we saw kind of that initial burst of inflation. And now you're starting to see purchasing power really normalize. So I think that's good for the consumer. It's what you would want to see. You want to see a period where wages are actually kind of outpacing inflation. because that's going to get you back to kind of a little bit better purchasing power picture. You're going to be able to cope with these higher prices, all else equal, because you're unlikely to see prices outright decline, right? We're unlikely to see outright deflation. We're not going back to 2019 prices. So the way that the consumer, that the U.S. economy kind of copes with that is we need to see a period of wage inflation a little bit stronger than price inflation. And we are seeing that. I think that is an encouraging thing to be optimistic about the U.S. economy, which we are. We expect growth to continue at a pretty strong pace over the next 2 years.
All right, Stephen Juneau, Bank of America Securities U.S. economist. Thanks so much for taking the time to hop on with us this morning.
Thanks for having me on.
Well, coming up, we will dive deeper into March's CPI print. Again, taking a look at futures reaction to the print that came in line with expectations. You're still looking at that all three of the major averages on track to open the day in positive territory. The Dow futures up just around 0.4%. We'll be right back.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Futures are pushing higher this morning on the heels of a fresh read on inflation data. Inflation pressures easing in April as consumer prices rise at the slowest pace in 3 months.
And the U.S. consumer is showing some signs of weakening here in April. Retail sales were flat for the month. That was according to the latest data out this morning from the Commerce Department. Now, despite the fact that we are seeing a weakening in the economy, investors, though, looking at this as a positive sign for the Fed's rate cut plans moving forward. So let's get right to it. The 3 things that you need to know. It's your roadmap for the trading day. Yahoo Finance's Jennifer Schomburger, Madison Mills, and Brian Sazi have more.
The Consumer Price Index showed progress, clocking in at 3.6%, for the month of April, in line with expectations, though unclear whether this changes the calculus for the Federal Reserve. Fed Chair Powell said Tuesday his confidence that inflation will keep cooling is not as high as at the start of the year, and that the Fed will need to be more patient before lowering rates. Take a listen.
I think that it may be that takes longer than expected to do its work and bring inflation down.
The new data cheering investors looking for progress on inflation. Right now, odds of a first rate cut better than 50% for the month of September.
And the consumer showing signs a little bit of slowing in April. Retail sales were pretty meh, coming in flat, according to data from the Commerce Department. The update, though, on consumer spending coming as economists closely watching for signs of any weakness in the consumer amid the Fed's desire to find some reasoning to cut back on those higher interest rates. Investors are going to be looking for more signs of consumer slowdown, with quarterly results coming in from Walmart and Under Armour. That will come out on Thursday.
And China vows retaliation to U.S. tariffs. This comes after President Biden announced to raise duties on $18 billion in Chinese imports on Tuesday, including electric vehicles, steel, aluminum, semiconductors, and medical devices. Yahoo Finance spoke exclusively to President Biden, who said this is all about protecting American workers.
It's about being fair. And look, it's about saving American jobs, because if we allow them to continue what they're doing, to flood the market with EVs that are incredibly cheap.
Our top story this morning, inflation showing some signs of cooling off here. The headline inflation print coming in below estimates, up 0.3% month over month versus the 0.4% that was expected coming into the report. Core CPI, excluding that volatile food and energy category, that came in line with expectations, both month over month and versus the year prior. We're also watching some of the reaction here in the stock market with about 27 minutes until the start of today's trading activity, Shauna.
Yeah, Brady, you can see we spiked here, hit the highs of the session right after that CPI print was released. Also, retail sales, the fact that that came in lower than expected. A lot of the move higher that we are seeing in the pre-market trading really being attributed to that retail sales print. Let's also take a look at the move higher that we saw in S&P futures. We are just off the highs of the morning, and that's the same case for the Nasdaq 100 futures as well. And taking a look at the bond market, Treasury prices moving to the upside. We've seen a bit of a spike here as yields pull back just a bit. That's the case for the 10-year. That's the case for the 2-year here. So again, a couple of key trades to keep in mind today as investors digest the numbers that we got out this morning and try to figure out what exactly that means for the Fed moving forward. Well, Wall Street right now, it's cheering on April's CPI print, showing the fact that inflation may be cooling, at least on a headline basis. Core inflation also coming in line with expectations, and we are seeing green right now across the screen in reaction to that print. But we want to take a closer look at the typical stock performance after these inflation prints, and who better to ask than our very own Josh Schaefer. So Josh, break down the action that we're seeing this morning and how that relates to the action that we've seen over the last several reports.
Yeah, Shauna, so when you take a look at how stocks have typically reacted to CPI prints, this is using data over the past year, you would see that the S&P 500 with a reading like today would normally be about flat by the day's end. Now, of course, we're still only in pre-market trading, so it's a little tough to make too much of the moves right now, but you're seeing a bit of an outsized move to what you would typically see off this kind of CPI print, and you guys were just mentioning, I think it's because today is a little bit of a different CPI day where we also have retail sales. You have retail sales come in weaker than expected, retail sales flat in April. You sort of combine that with signs that inflation is slowing, which again, inflation in line, but it showed that inflation is slowing. I think that's why you maybe get a little bit of an outsized performance. The other side that we looked at here was also the Russell 2000 and small caps. And normally you would see outsized performance from areas like small caps, areas like non-profitable tech, when we have an inline print or even a better than expected print. So normally you'd see outperformance from the Russell to some extent there. And again, I think when you look at futures right now, futures tied to the Russell 2000 are outperforming the S&P 500, largely because you see consumer spending slowing down a little bit, inflation coming down. That sort of fits your we might get a rate cut at some point this year narrative, and normally that helps small caps, right? Mm-hmm.
And so all that considered, I mean, where are we expecting to see some of the outperformance if we have a plateau in inflation like Greg Dacco from EY was telling us about over the summer here as well?
Yeah, I mean, I think if you have a plateau, Brad, that's really weighed on small caps, right? It's weighed on small caps. It's weighed on the riskier areas of the market, like a non-profitable tech sector, and that has not performed that well. If we have like you said, a plateau in inflation over the summer. Yeah. Then people are going to start pricing out rate cuts again, right? And as you price out rate cuts, we have clearly seen on days that happens, you can look at the Russell 2000 and it basically for the last year has always done worse than the S&P 500. So it's usually a goodwill measure to see what people are pricing in that day and sort of what the read is on the Fed. If you look and the Russell is well below the S&P 500, it usually means people aren't feeling too bullish on rate cuts and sort of vice versa as well.
Yeah, exactly. It's really important to point out, and also tells us maybe about what the leadership will likely see then, or lack thereof, or underperformance that we could see in the markets over the months to come. All right, Josh, thanks so much. Let's stick with that top story of the day. Key inflation data coming in line with expectations. Traders are getting some reassurance that the Fed could potentially cut rates later this year. About 50% of traders are pricing in a rate cut in September. That's up about 1% prior to the report's release. So we didn't see too much of a change here, at least yet. We want to bring in Matt Stuckey. He is Northwestern Mutual Wealth Management's Chief Portfolio Manager. Matt, it's great to have you here. So when you take a look, let's just first start with the market's reaction to this print. You've got CPI coming in line with expectations, retail sales coming in weaker than expected. We are seeing some gains here ahead of the open. How are you looking at this move higher?
Well, good morning. Thanks for having me. In terms of the market reaction, I think this is a pretty clear indication that the market's reacting to this as a across-the-board soft print as you look at both the CPI print as well as the retail sales. And really the clearest way you can look at that is the September rate cut odds. Going into today, you kind of had the market pricing in one cut, maybe a small percentage chance of a second rate cut, but now we're kind of pricing in two cuts now. And that has implications for markets. It tends to lift equity prices, as you've discussed already, but it also has style implications. And small caps, as was just mentioned, is one of those beneficiaries of real rates moving lower. And so we expect that to play out today in the market.
Matt, what's also interesting here is, I mean, at least on a basis point level, it looks like there's a significant jump in the percentage or the probability of a rate cut coming in July as well. I thought July was totally off the table here, but coming into this, according to the CME FedWatch tool, just yesterday we were sitting at about a 26% chance of a rate cut. That's jumped to about 32.5. Now, sure, that's not the outsized opinion, but it still means that this could be lingering out there in the market. To what extent are you looking at a July versus September being that first cut?
Well, I think we got to really watch the labor market as well as retail sales to give us an indication whether or not that probability that jumped about a tenth or so is going to continue to move higher. And what I mean by that is retail sales tend to lead CPI by a couple of months. So if this weakness that we saw in retail sales of the consumer pulling back a little bit were to continue into the month of May and June when we get those reports, July may very well be on the table if that trend were to continue. But our view is not to overreact too much to the data on a monthly basis. If you look at the 3-month annualized trends, there is a story to say that the consumer is pulling back though. So if this continues, July may be on the table, but right now we don't want to overreact to just 1 week retail sales report. When we look at the prior 2 months ahead of this report today, they were fairly strong. And so there is some volatility in the data that we have to respect here.
Matt, I'm curious how you're looking at the recent rally that we've seen in a lot of these meme stocks. We're seeing that rally cool a little bit this morning, but does this signal anything about the broader economy? Does it tell us anything about the health of the consumer, the resilience of the consumer? I'm curious how you're looking at that and then factoring that in to where things stand today.
Well, I think it's one of those things that makes for probably good TV segments, but I'm not so sure that it really impacts the consumer so much. Look, I'm probably the wrong individual to ask about meme stocks. I tend to be more fundamental with our investment decisions as we relate to kind of how we're managing our equity portfolios. But it is interesting that the consumer is still out there and willing to take risk. And the definition of the meme stock craze is risk taking. So, the consumer must still be in a fairly decent position to kind of risk to this level. with the whole kind of idea is that you're buying a stock with the anticipation of it just moving higher in the form of a momentum trade and a short squeeze. So that's not quite the investment strategy that we would recommend, but clearly it's a popular one today.
So then, Matt, should macro investors then just be ignoring what's going on right now in the meme stocks?
I don't think it's really impacting macro forecasts, no.
All right. Matt Stuckey, great to have you, Northwestern Mutual Wealth Management Chief Portfolio Manager. Thanks so much.
Well, China vowing to retaliate here after President Biden announced new tariffs on certain Chinese goods yesterday. These include a 100% tariff on Chinese electric vehicle imports, a 50% tariff on Chinese solar cells, and a 25% tariff on certain Chinese steel and aluminum imports. Yahoo Finance's Brian Sazi spoke exclusively to President Biden yesterday and asked about any actions China might take. Take a listen, and then we'll talk to the man that you see on screen right now.
The fact is, China already is what you might say way over their skis on this. What they'll do, I don't think it'll lead to any international conflict or anything like that. But I think they'll probably try to figure out how they can raise tariffs maybe on products that are unrelated.
Okay, let's bring in Brian Sazi now. I mean, China has already kind of looked at this scenario and announced its own potential action that they would take if the administration does not step back off of what it had already announced here.
Yeah, I would say it's unclear precisely how China reacts. We've seen they've put out some comments, of course, some chatter on various social media channels, but it's unclear if they respond tit for tat. Remember that saying during the Trump trade war? Is it a tit for tat? So the U.S. comes out here, $18 billion in tariffs. Does China respond to that exact number, or do they go even further? I would even add, too, this might just be the opening bid or the opening start here for President Biden. Do they take this even further in an election year when he and his administration want to highlight what they're doing in terms of manufacturing and bringing back jobs to the country, whether it's in semiconductors or other important industries? So this may just be a starting point. And then if President Biden should win re-election, does this go even further? And then conversely, I mean, you heard some comments from former President Trump, who's been out there suggesting 10% across the board tariffs. We talked to a lot of economists. They're saying that would be really detrimental to the U.S. economy. He ramped up that rhetoric recently, saying, I think it was last weekend or earlier this week, 200% tariffs on China EVs, which is basically is a ban. I mean, it's not happening. But nonetheless, I asked President Biden a little bit more about China. He noted that China may just be really artificially propping up its economy. Take a listen.
China is fundamentally underrating their entire industries. They're just they flood a market. They pay whatever it takes to flood it. They make sure to put everybody else out of business and they take over. Or, for example, even if you want it for the longest time, if you want to do business in China, guess what? You have to have a 51% Chinese owner. You have to make sure that you're, in fact, going to make sure that they have access to the intellectual property. It goes on and on. It's about being fair.
And we've been covering the economy for a long time. We've been doing this for a while. We hear a lot of leaders, CEOs, politicians talk about how China is dumping steel in the market or aluminum, but we also had the opportunity to talk to a lot of actual CEOs in the trenches, the CEO of Century Aluminum, for example, talking about how China has been dumping cheap imports or cheap products into this country, driving down prices. These are real things that are happening. And one stat that really blew my mind, there's only 4 smelters in the United States, or smelters make essentially aluminum. Now, Century Aluminum is building the 5th one, amid help from President Biden, the administration, various grants or loans. But that production has pretty much went overseas. To have 4 smelters in this country making aluminum, which impacts tin foil, it's just like, oh, I didn't realize that.
Yes, Saz, I'm curious with your conversations, because you talked to a number of the other officials within the Biden administration, a number of CEOs when you were down in D.C. yesterday. Great interviews,
Thank you.
by the way. But what did you learn just about their sense of what they're seeing from the consumer, the sense of how strong and resilient the economy has been, and how they are navigating this uncertain time here with their business?
I do want to couch this in saying I don't think anyone that we talked to inside the White House was going to say the economy sucks. It just wasn't happening. These were folks invited to the White House. They participated in the Rose Garden ceremony. It was a big moment for them. We got to talk to them off camera. But I didn't get the sense, just watching their eyes in these interviews, hearing how they're talk, that this is an economy falling off a cliff today, or likely to fall off a cliff a couple months or even a year from now. Was it gangbusters economy? didn't get that sense either. But this economy, by all indications, continues to be growing. There's demand for steel. There's demand for aluminum. The world is not ending.
All right, well, Brian, congratulations on those great interviews
yesterday. Thanks for the help to the team. I appreciate it.
Of course, and you can catch Brian's full interviews here on Yahoo Finance, our live programming throughout the day, and then, of course, on yahoofinance.com as well. Well, we are just getting started here on the Morning Brief. Coming up, Wall Street is getting more bullish on Alphabet after the company announced new AI features at its conference yesterday. We will break down just what those features are and what the street is saying on the other side. We'll be right back.
Boeing has violated the terms of the agreement it reached to avoid prosecution over the two deadly crashes involving its 737 MAX jets, according to the Justice Department. Prosecutors now have until July 7th to decide whether or not to file charges against the plane maker. You're taking a look at shares of Boeing here year to date. They're down by about 30%. Of course, this has been a year with even more swirling around the company, especially following the fuselage blowout of an Alaska Airlines flight, separate from the two 737 MAX crashes that really started the spotlight of scrutiny over the internal culture that came to light of negligence, and then additionally ousted CEO thereafter, and Dennis Muhlenberg at the time, and then you had Dave Calhoun, and now he is on the way out as well. And so all of these things considered, it'll be interesting to see what the Justice Department ultimately has in terms of its ruling as a result of this deal that they had reached. I mean, a deal that was essentially a slap on the wrist, given the crash the proceedings that took place thereafter, and of course the families impacted as well from those two deadly crashes.
And Boeing has about a month until June 13th to challenge the department's findings here. That was according to a letter that the Wall Street Journal cited. And Boeing, at least from the statement that Wall Street Journal got, looking to test some of these findings here. They believe that they have honored the terms of the 2021 agreement. No surprise. We obviously expected them to say that, saying that they are going to engage the department with the utmost transparency, as we have throughout the entire term of the agreement, including in response to their questions following the Alaska Airlines 1282 accident. So again, Boeing standing by what they have done here over the last several months, just in terms of upholding that agreement that they had agreed to back in 2021. But again, I think this just adds even more clouds here that are an overhang here for the stock. When you talk about the fact that analysts largely remaining actually bullish on Boeing, given the current valuation, given the underperformance that we've seen since the start of the year. It's going to come under new management. We are going to get a CEO, and many of the analysts that we have talked to here in Yahoo Finance remain optimistic on Boeing's business going forward. I think the next couple of months might be a bit murky as we do work out the details, as we do get more and more here. But again, we have seen that massive underperformance of Boeing stock since the start of the year, and as a result, despite all these issues, it's been interesting that Wall Street has remained largely bullish on this name.
Right, and largely because Boeing had already set aside even more than they had pledged within the settlement. It was about a $500 million settlement that they had made for the families, specifically in the fund there. Boeing had already set aside about $2.5 billion there. So it's really just kind of looking at what they're already doing on their own balance sheets versus what's actually coming forward within the rulings. And of course, this is just another step in that as well.
All right, let's get to Alphabet here, trending ticker on Yahoo Finance. AI announcements yesterday during its developers event. It's getting the street's attention. Goldman Sachs is feeling bullish, saying that the tech giant is now the, quote, lead collection of AI machine learning driven businesses. They are not the only one. A number of analysts weighing in on the announcements that we got yesterday from Google, Evercore, ISI, saying that Google delivered in this year's I.O. against a mounting of hype and doubts here. They also went on to say that they have successfully proven that it will remain a leading player within the AI race. Stifel pretty much in line saying the same thing, that they are encouraged by Google's ability to continually enhance its positioning across the AI landscape. And this comes at a time when I think the criticism towards Alphabet has been that they have largely been viewed as a second player when it comes to Microsoft. Microsoft, with the OpenAI agreement, clearly viewed as the biggest winner, biggest beneficiary so far, the leader within the AI race, and Google largely viewed as second in that line. And I think that that is starting to be debated now. It has been debated, I should say, actually, for quite some time. But the announcements that we got yesterday reaffirming some of those doubters out there in the street, and really Google solidifying its position within this race and where they see the business going over the next several years.
It's really particularly interesting here, especially as Google or Alphabet had already experimented with what used to be Bard. It was Bard, then it got rebranded, now it's Gemini. And so there's even more investments that the company is putting forward, as they've talked about on their earnings call as well, not just with the business to consumer element or application and how people are going to really feel the difference at the touch of their fingertips of generative AI for their own productivity, but how companies, and especially thinking about the cloud services side of the Google businesses on Google Cloud, wherever they're able to overlay even more of their artificial intelligence or generative AI, you can almost kind of annex that more into how Salesforce is talking about layering that into their cloud, or Amazon Web Services is talking about layering it into their cloud services to supercharge some of the productivity and data connectivity as well for their clients. And so it's just a question of what is the accurate multiple that investors should assess on top of these companies as well going forward here. And I think as we get a gauge on what the exact spending looks like, that's when we'll get a little bit more of a clearer picture on that.
Let's take a look at New York Community Bancorp, because shares are rising after announcing it has agreed to sell about $5 billion worth of loans to JP Morgan. Now, the company's CEO is saying in a statement, quote, "We are moving forward quickly to implement our strategic plan, which focuses on improving our capital, liquidity, and loan to deposit metrics." When you take a look at the reaction in shares, you're looking at gains of just about 3% here in the pre-market. The reason why here is largely viewed as the fact that this is going to strengthen NYCB's capital ratios here going forward. That was largely the assessment here from the street. Still lots of questions just about the stability of this business, the headwinds that New York Community Bancorp faces when it comes to their exposure to New York, specifically New York's commercial real estate sector there, and what exactly that pressure could put on their business here in the short term. But again, this announcement not a surprise. Management pretty much signaled it here in the last earnings report. But again, at least the street is looking at this as a bit of good news because of that capital allocation.
Yeah, and the street should be looking at this for what it is. It's a liquidity play. And the company has talked about that, making sure that they're trying to bolster their liquidity profile right now. It seems like the proceeds of the sale is actually going to be reinvested into assets, including cash and securities. So looking at where ultimately the results of that sale are able to really bolster the capital ratio for this company. And that's where investors should expect to hear more from the executives about this longer term plan that the company is talking about. But this ultimate commitment letter plus with JPMC rather, and the proposed transaction with pure efforts to just try and get into a better liquidity profile going forward here.
All right, well, we are just minutes away from the opening bell on Wall Street. Again, we are looking at gains likely here at the open with all three of the major averages here. Futures at least pointing to gains at the opening bell. 3 minutes from now, we'll be right back.
Welcome back, everyone. I'm Brad Smith. That's Shauna Smith. We're giving you a countdown to the opening bell here this morning. We're just seconds away, taking a look at some of the futures as we've been tracking the Dow, the S&P 500, and the Nasdaq on the back of today's CPI print for the month of April, plus retail sales. They're still pointing higher right now. The Dow futures up by about 0.4%. Also seeing some fractional gains for the Nasdaq 100 futures and the S&P 500 futures here too.
Yeah, certainly. We'll see whether or not these gains hold. Again, a weaker than expected, or inline print when it comes to CPI, weaker than expected retail sales print. So that is really moving the markets here right at the open.
All right, there you got two bell ringers, two different places. Pinterest, oh my gosh. Look, that reminds me, I need to go back and refresh my Pinterest board just to see what's going on.
I paid you for a Pinterest guy.
I mean, I've got a Pinterest board that's for Lukes, as they would call them. I've got a Pinterest board that's for the homes that are made out of shipping containers. Love those. Great ideas there. Inspiration, inspo. And then Lionsgate Studio ringing the opening bell at the Nasdaq too. All right, let's take a look at the markets here, sponsored by Tasty Trade. Fractional gains across the board to begin today's trading activity on the back of this morning's economic data that we've been tracking.
Yeah, Brad, we're looking at the Dow up just around 181 points, the S&P up around 0.5%. Taking a look at the sector action, at least right here at the open as we shake out the opening trades right now. But again, we are seeing some leadership within real estate and utilities. We got energy lagging here just a bit. So again, some key sectors to keep an eye on. And the materials also back in favor. That's up just around 0.6%. But let's get over to Jared Blick, who has a closer look at some of this movement that we're seeing. Jared.
Yes, I'm taking a look at futures this morning, and let's start out with copper, because in U.S.-listed COMEX copper, we are in the midst of a short squeeze, and you can see we're just at the unchanged line right here, but let me show you the last 5 days. It doesn't look like a lot, but 4% is huge in the highly levered industry of commodities. Now, 5 is a big psychological number, and I should say there's some arbitrage going on between copper that's deliverable overseas. It's being rerouted to the U.S. where we have the short squeeze. And just by way of a longer term chart, you can really see how this is accelerated to the upside. So we will keep an eye on that. And by the way, fundamentals in the macro environment, they favor copper as well. So let's take a look at crude oil. Crude oil down a little bit. We do have, and this is WTI here. This is a 1-year chart, and here's an intraday. We do have some news from the IEA. They just updated their demand forecast for the year. Still going to be an increase of 1.1 million barrels per day, but that's a little bit less than they anticipated. And let me show you a 3-month chart with some candlesticks, and you can see we are now breaking what was a support line, so could go a bit lower if we get some momentum on here. Now, I also want to cover gold, because gold actually shot up on the announcement, and I'm looking for GC equals up. There we go. Let me show you the intraday, because on that CPI print, we got a nice spurt upwards. Why is that? Because the Fed is more likely to cut rates because it came in line. So that's the theory, and that's what happened in gold futures, holding above 2370 right now.
All right, Jared, thanks so much for breaking down some of the movement that we're seeing here at the open on the heels of that CPI print. Well, April's inflation data coming in line with expectations. It's pushing stocks higher, at least for now, to start the trading day. But what could this signal for the Fed's path forward? We want to bring in Blake Gwynn. He's RBC Capital Markets head of U.S. rate strategy. So, Blake, let's start actually talking about the move that we're seeing here in the bond market, because that makes a lot more sense here. You got treasuries rallying just a bit. You got yields coming under a little bit of pressure. Do you expect this movement that we're seeing here this morning to hold?
Yeah, I do. I mean, I think, coming into this inflation data this week and retail sales today, I think this kind of no landing hike narrative that had really picked up in the last month or so was definitely feeling a bit stretched. I think we had that very, very positive run of data in Q1, and markets started pricing out a lot of the cuts that we had coming into the year. But I think as we heard from Powell that hikes were off the table, not that surprising to us, but I think markets had at least started to price some of that probability that there may be a hike this year, that we would reopen that conversation. That has come out of the market post Powell, and then with kind of the softer NFP, and I think that basically is continuing today. I think that has probably a bit less to do with the CPI print. As you said, it was in line. I don't take a lot of signal from that. I think it's very much kind of a Goldilocks kick the can type of print for the Fed, but I think the retail sales, the softness we saw there, certainly a bit of relief for the Fed, and I think it's what markets wanted to see to kind of continue this very, very modest rally that we've seen over the last week.
And so with that in mind, do you think markets, without going too far down the line of, strategy and investment strategy, but do you think we could potentially see more all-time highs, even if we did see some start to sputtering or more of a trend get locked in that would then point towards a cut to come at some point?
All-time highs in yields, you mean? I think for our view, if you kind of look at where we were in that 450 to 5% range last fall, which as of now stands as kind of the high for this cycle, I think those yield highs are going to be very difficult to get to. I think a lot of people were kind of focused on that several weeks ago, when we were pushing higher. And as I said, kind of that no landing hike narrative was really picking up. A lot of questions were coming in about, are we going to see, return to 5% 10s, that kind of thing. I think that door is largely closed. I mean, I think if you look at where we were last year with, still pricing in some probability of a hike, a much better string of data than even what we were seeing in kind of Q1. The data was very, very strong, I think, in August last year. And on top of it, you had these kind of term premium concerns around treasury supply and deficits and things that really added to that move. And I think all of those things, basically across all those fronts, we've softened up this year, and I don't really see those coming back to the floor. So I don't really think we're going to see a retest of that kind of 5% high in right. yields again. I think we've seen the highs for the cycle already.
And that's my bad, Blake. I was speaking with regard to the equity markets, but that's me on the confusion there.
I'm a bond guy. I think rates.
Totally. We know. You're just so well versed in everything, Blake. But while we do have you here, we've heard the way that the consumer is described shift so much over the past 18 months. We've gone from the consumer is resilient to the consumer is healthy to now the consumer, in more of the conversations we're hearing, is stretched. How would you define the consumer?
I think there's a very interesting question right now that we're kind of mulling over on the desk. And, this is probably more of a question for the Economist to answer than myself. But I do wonder if what we're seeing, and I think the retail sales today generally vibes with what we've been seeing in, large retailer kind of earnings calls over the last month. But I do wonder if some of the softness on the retail side, is it more about consumers not being able to spend and seeing kind of cracks in their ability to continue consumption, or are we finally seeing some pushback against pricing increases? Is this less about their ability to spend and more that they're finally putting their foot down and saying, look, I'm not spending, $8 for a cup of coffee or whatever it is. I think the former is certainly more problematic for the Fed. If this is really cracks in their ability to spend, they're getting stretched. They don't have any more dry powder. They're not, the income increases have started to slow. If that's really more what's driving it, I think that's a bit more problematic for the Fed, because that can certainly accelerate into something, a bigger slowdown. If it really is we're seeing this kind of pushback between consumers and corporations as far as prices, that's a bit less problematic for the Fed, because I think it means we could continue to see inflation come down, and that consumption really isn't, that slowdown in consumption isn't really kind of true cracks in their ability to continue consumption, throughout this year and maybe even into next.
Blake, does this at all change the calculus for the Fed? And I guess how do you think, what does the Fed need to see in order to gain that confidence in terms of how much more improvement does it need to see on inflation before we do see that first cut?
Yeah, it's a great question. Powell is asked in many different ways at every press conference as some version of this question. Luckily, I'm not a Fed chair, so I can answer it. I think from my own perspective, we've basically got two CPI prints, 3 PCE prints to go before the July meeting. I think you'd probably have to be talking about a 0.2 month over month in core in both of those prints to get back to a point where the Fed could even consider cutting in July. We've been roughly putting those odds around 30%. I don't think that calculus has changed today. I saw it as 30% a week ago. I think even post this data, and this is what I was kind of talking about with the kick the can down the road Goldilocks type of print. But even with today's inflation data, I would still put July at around a 30% probability. Just, for kind of a fun fact here, I mean, if you see 0.2 prints in CPI for the rest of this year, you're still talking a 3.0% year-over-year increase in core CPI. If we keep printing 0.3s like we saw today, you're talking about just under a 4% year-over-year inflation rate. So actually increasing from the current levels year-over-year. So just kind of putting in perspective that this 0.3, while I don't think it closes the door on a July cut, it certainly doesn't make a hike any more likely. It's definitely not consistent with, I think, what the Fed wants to see for the rest of the year.
Really interesting. Blake Wynn, who's the RBC Capital Markets head of U.S. rates strategy. Blake, always a pleasure to grab some of your time and get some insights.
And thanks for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. The meme stock frenzy slowing down a bit this morning. This came after GameStop and AMC rallied over 110% in the past 5 days. The stock craze looks a bit similar to 2021 when the frenzy first began, but not quite the same in its long tail. So let's break down how this rally compares to a couple years ago with a little walk down memory lane. Now, you have some aspects that are similar, some that are a little different. First and foremost, CryptoKitty, a part of both of them. And of course, the DFV that was talked about on YouTube from CryptoKitty and some of the other accounts that were showing why they were piling in to some of the biggest short positions in kind of this rage against the machine, mimetic type of mentality that really permeated and led to really making sure that a lot of those short positions that were piled into GameStop, AMC, companies like that would have to cover their shorts. So we knew this short squeeze initiated. And here's where I'll actually jump to the bottom just very briefly here. At the time, you saw short interest over 100% in stocks like GME, GameStop. And so the short interest vastly different this time. Last I checked, it was at about 24%. What's also changed is that you don't have the same type of short sellers publishing their research. So a little bit more tepidness to be outward about the positions that they've opened up here. One of the other things that's interesting, let's think about the mindset of the retail investor here in 2024 versus back in 2021. Everyone had what they were tweeting about at the time or posting on social media, the viral stimmies that everyone was putting back into the market. So those pandemic stimulus checks, nowhere really to be found. And in fact, the consumer mindset has changed drastically. That consumer and the retail investor perhaps going a little bit more hand in hand here as you're thinking about where the consumer has gone from resilient to healthy to now, as we were discussing with some of our Economist guests, stretched is the word that's starting to emerge a little bit more. And then just lastly here on the regulatory front, it's far different in terms of the environment. We've heard proceedings take place in Washington, D.C., calling forward everyone from Keith Gill to Robinhood CEO Vlad Tenev, and then even some of the large hedge fund leaders out there. And so all of that considered, the action that was taken is vastly different. Of course, back then in 2021, it led to a halting of specific stocks. We haven't seen that. Just a couple volatility trading pauses to date here. That took place yesterday, but volatility seems to have subsided just a little bit here on the day, Shauna.
All right, Brad. Well, traders driving up some of those meme stock prices with no real financial fundamentals backing the price this week. So what does this mean for the broader market? What does it mean for you, the average investor out there? We want to bring in Paul Atwater, Financial Insights president, joining us. Paul, it's great to see you. So you have a real great pulse on investor sentiment right now. So tell me just how you're looking at this renewed excitement that we have seen surrounding the meme trade and maybe what that signals here for the broader market.
Yeah, so the meme stock trades tend to only occur at extremes in sentiment. And so to me, this is yet another mood indicator that the markets are reaching a point where we should expect some sort of a meaningful pullback because, if we look at the relationship between, stocks like GameStop and the broader markets, this coincidental euphoria seems to be repeating over and over.
And so the same stocks over and over, is that what we should expect, Paul?
Well, my name is Peter, but
Peter.
More importantly, these stocks tend to reflect the broader sentiment of euphoria. We only see folks piling into AMC and GameStop and these companies that are pure speculative value at extremes in sentiment. These are an example of confidence elasticity at its best, that we have to feel in a particular mood to be eager to buy them. And so what we've seen is that this is a repeatable pattern. And what is likely to occur is that this is marking a major peak in the markets.
So, Peter, with that in mind, it sounds like maybe investors should be getting a bit cautious here. Any idea just in terms of what we learned from 2021? Because clearly the levels that we're seeing today, we're not near the levels that we saw in 2021. But even despite that discrepancy, you still think that just because of this euphoria and because we have this momentum back in some of these names, it still is a worrisome sign here then for the broader markets. We don't have to get back to those levels then.
And to me, this is part of a broader mosaic of extreme sentiment. We've got the VIX down, at prepubescent levels. We have spreads in corporate bonds back at 2007 levels. We've got excitement in the mortgage market at a comparable 2007 level. So this fits with a broader series of indicators of mood that suggest we're getting extended.
Okay, so where, if anywhere, from here does some of the flows typically go to after a mimetic trade or momentum trade period has subsided?
So what you see is the crowd exits quickly. So we should expect that as burst filled as this last week has been, there should be a comparable bust coming in these names. The thing that distinguishes bubbles from other kinds of behavioral patterns is that first step is the steepest. So if this is an indicator of mood, we should expect these companies to leave via a high story window quite quickly. Now, having said that, where does cash go in this situation? It tends not to, because so much wealth is destroyed. Remember, too, that the cost basis for a lot of people is this week. And so there's a lot of feelings of pain that happen to those who are last to this party.
Peter, if you could break down for our audience, just in terms of the retail interest versus institutional interest and the risk that this poses here to a retail trader versus institutional, just in terms of what we learned in 2021 and the fact that institutional tends to exit quicker and retail may be more at risk.
Yeah, so the retail investor tends to arrive late and exits late. So they tend to hold on in the belief that this too will resurrect itself. And this is, to me, one of the psychological consequences that we're likely to see, given this extraordinary bounce in the meme stock names, that this is now affirming that belief that it pays to hold on until the very end. And so that, to me, suggests that the retail investor is likely to incur a huge amount of pain ahead, because this trade tells them never sell.
Peter, thanks so much for taking the time here with us today. Peter Atwater, Financial Insights President.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. The earnings report the street is waiting for, of course, Nvidia, which will report results next Wednesday, and positive forecasts are rolling in ahead of the report. The consensus calls for revenue of $24.51 billion for Nvidia's first quarter, rising to $26.52 billion in its second quarter, according to FactSet. Shares are up over 80% year to date here. And of course, this is going to be the true barometer for the continuance of the generative AI conversation and how much is left in that thematic trade strategy as well right now.
Yeah, at least when you take a look at the analysts' anticipation here of this report, it looks like it's going to reaffirm this trend that we have seen over the last several quarters, that Nvidia is by far the leader within this space. The fact that they do have this moat, at least right now, such a wide lead over so many of their competitors, it looks like that is going to reaffirm some of this excitement that we have seen surrounding Nvidia. When you take a look at some of those expectations and where we are expected to see some of the most strength within this report, UBS calling out their analysts there, saying that they expect a first quarter beat, specifically driven by stronger than expected lead times preceding those results. And as a result, they see about 26% upside to the stock here. $11.50 price target for shares. So again, more of that upside there. And here we are, not too shy from $1,000 a share. And we could see that 1 year chart pretty much explains it all. I mean, you've got another gain of about 218%. When you take a look at these lofty expectations and this pattern that we have seen from Nvidia in recent quarters, really surpassing the street's lofty expectations, beating them by a mile, and then their guidance really driving the stock higher following the results. When you take a look at the expectations, at least this time around, analysts seem to be anticipating a similar type of move.
Yeah, and it really comes on delivery times here too. As we're thinking about lead times coming in substantially, enough room for posting revenue potentially as high as $26 billion, as we've been talking about here. With the buy ratings that are on Nvidia right now, it's a larger question of what type of multiple the analysts can comfortably continue to tack on to Nvidia. And at this juncture, I mean, it's like the de facto play, as it's been called by some analysts in the past, for a generative AI exposure to the portfolio. And so how much of that de facto measure continues to get tested by what is, and it feels like this is what, the third straight earnings report where we're saying this is supposed to be a Goldilocks type of report that they're coming into here for Nvidia, and they've continued to surpass to the upside every single time, it seems like.
They have, and it looks like in terms of some of those key things to watch within this report, the software run rate, that's one of the things that analysts will be keeping a close eye on. Also, just in terms of networking sales, what that figure is going to be in GB200. Those are some of the key things, key factors, key metrics that investors will be keeping a close eye on when we're trying to figure out what that run rate looks like and what their full year estimates are going to be. Any changes maybe to that, to the upside. All right, well, coming up, Madison Mills is joining me here for Catalyst in the next hour. We're going to be taking a deep dive on that CPI print that was out this morning, whether or not it is a bullish sign for the markets. Plus, muni bonds, are they a good place to park your extra cash? We've got you covered with that and more. We'll be right back.
10 a.m. here in New York City. I'm Madison Mills alongside Shauna Smith, and welcome to Catalysts.
It's Wednesday, May 15th, and let's dive into the catalyst moving the markets today. First up, it's all about inflation. April CPI showing signs of slowing price growth. The core CPI print cooling for the first time in 6 months. And that could be and is welcome news for the Fed. The data causing and pushing stocks up here with the S&P hitting a new all-time high.
And the meme stock rally fizzling out here. GameStop is falling today after soaring over 300% in the last month. Does this mark the end of the current frenzy around meme stocks?
And China vowing to retaliate after President Biden announced sweeping trade tariffs that would impact $18 billion in imported Chinese goods. The Ministry of Commerce saying that the U.S. should immediately, quote, correct its wrong actions and cancel the additional tariff measures against China. Let's start with the big story of the day, and that is the latest data that we are getting out on inflation. We got a softer print here for the month of relief from the 3 hotter than expected reports that we got to start the year. But is this moderation in prices, is it enough to ease some of the Fed's concerns? One of the areas that we are seeing prices remain sticky is shelter, the largest factor in April's monthly increase, thanks mostly to high rent prices. I asked Stephen Juneau, the Bank of America Securities U.S. economist, when we could start to see some relief, and here's what he had to say.
We're looking for firmness over the next few months. I think the second half of the year is probably where you start to see a little bit better improvement. So instead of 0.4s on shelter, on OER, on rent, maybe you're in the 0.3 region. So you're getting kind of that step in the right direction. And that's going to be a source of relief for the Fed.
So we're getting a step in the right direction, as Stephen Juneau put it to me last hour, Maddie. But when it comes to exactly what the Fed needs to see, we heard Powell talk about this time and time again. Treasury Secretary Janet Yellen also weighing in on the sticky parts of inflation, obviously rent being a huge driver of that. They've expected to see some moderation now for quite some time, some stabilization here. But I think when you take a look at least at the market, then we'll talk about this a little bit more in 1 second, but when you at least take a look at the market's reaction to it, to this print here this morning, the fact that we are seeing gains when it came in line with expectations, I think really shows just how on edge investors are right now about the risk of a reacceleration that we could see in inflation, and anything that just came in to ease some of those fears, at least for now, seems to be enough for the market today.
Absolutely. Definitely seeing a lot of optimism here. It's interesting on shelter. It's moved down on a year-over-year basis for the past 13 months. So that could be an indication of some more good news to come for the Federal Reserve. But sticking with that market action, the S&P 500 hitting another all-time high this morning as new data showing signs of inflation moderating and consumers cutting back on their spending as well. Even with some progress shown today on consumer prices, our next guest says we may not get down to 2% inflation even in the next few years. So what impact could that have moving forward? Joining us now, we've got Christian Lawrence, Rabobank Senior Cross-Asset Macro Strategist. Christian, thanks for coming in person. We appreciate it. So market's very happy about this CPI print. Is it a little bit too much happiness we're seeing?
I think so. And the reaction's somewhat complicated by the retail sales print because that came in much weaker than expected. So I think that was actually the main driver of the move lower in yields. And that move lower in yields certainly welcomed by the equity market and explains that all-time high in the S&P 500.
Do you think this move that we're seeing today then is just a blip? How do you expect to see this play out here over the trading session? And then, of course, as investors have a little bit more time to digest the reports that we got out this morning?
Well, the sensitivity to data releases is going to continue, and we will see these very large reactions. You know, we see it pan out in the rates world where moves of 10 basis points in a day. We saw that yesterday as well. These will become and will remain very common features. And I think we're seeing a little bit more sensitivity also to the activity data than previously. We know the inflation numbers, yes, they're down from the absolute peak, but I still think we're going to see some sticky pressures. Look at that shelter inflation there. That's a real key point. And of course, shelter is one of the main expenses for households.
Well, I just want to go back to what you said about retail being the catalyst for this upside movement that we're seeing today, because as you mentioned, consumers are spending a lot on things that are not measured by the retail sales print. So why should we be putting so much weight on that data point?
Well, I think in order to see real slowdown in inflation, particularly it's the services measure that we really need to focus on. And that's still printing at that 0.4% rate that it has done for quite some time. And without that easing, without seeing consumption start to slow, we're not going to get that 2% target. And I think there's other reasons why that 2% is going to be hard to achieve, more structural global factors, particularly related to more in the way of domestic production and more in the way of trade barriers going forward, as we've seen already.
Christian, there seems to be lots of questions just about how much stock we should put in this CPI print, just in terms of what this is really telling us about the deflationary story, if anything at all. How are you viewing, or what are your expectations in terms of inflation and maybe any sort of improvement that we could see in the coming months?
Yeah, well, it's so important to dig below the surface, right? And when it comes to shelter inflation, I don't see much relief in the coming months whatsoever. And that's going to keep that core services measure high. And actually, when it comes to goods, we had core goods deflation. I actually think in the next couple of months, some of the shipping costs we saw earlier this year, that's going to start filtering through, and we could actually get a little bit more upward pressure on that goods side of things as well.
What's it going to take to see more improvement, stabilization within the rental part, within the services part of this?
Well, I think that's going to be very difficult indeed. The structure of the housing market essentially means there's this deadlock because nobody wants to sell at the moment. And, most people that have a mortgage are fixed at very low rates. And we have one of the highest proportions of people not even having a mortgage at the moment and owning their house outright. So I think this is a real structural factor that means, to be blunt, rental inflation is not going back to the levels it was pre-COVID.
So are high rates inflationary?
Well, that's a very controversial topic. I think at this moment, with the way the economy is right now, there's a strong argument to be made for that.
So what does that tell us about what you think the Fed, what would make the most sense in terms of the Fed's path forward, the timeline of rate cuts, and exactly what we should expect to play out then, given the fact that it almost seems like by the week the narrative is changing surrounding the Fed. Not too long ago we were talking about, hey, maybe we could potentially see another hike. Now the sentiment and now the conversation has really turned to the likelihood of cuts, which I think makes the most sense. But what are you expecting to see in that playbook?
Well, I mean, when you look at the Fed's dot plot and you see at the end of next year one member has rates double another member, it shows you that level of uncertainty out there. So way back in September 2022, our view was 3 rate cuts starting in the middle of 2024, and we've only just changed that to 2 rate cuts. I think the risk to that is actually they don't go twice. But what I will say is that for next year, we only have 2 more 25 basis point rate cuts penciled in, and we have nothing for 2026 based on the idea that we are going to see a lot more in the way of tariffs, and actually inflation is going to be perhaps heading a little bit higher.
How much of the tariffs piece plays into your thesis there?
Yeah, that's a huge part. But as we've just seen, that is now a bipartisan issue. So we will see more tariffs. We will see essentially, it's not deglobalization, but it's a change in globalization. It's a re-globalization, and that's structurally inflationary.
Does that pose a risk here to the economy?
Yes, certainly. It also poses a long-term positive. We could see a lot more in the way of manufacturing investment. We already have. I think that that's going to continue. And it could set up for a healthy economy further down the line. But we know in the short term, tariffs can be quite painful, and they're almost certainly inflationary.
All right, Christian Lawrence, great to have you, and thanks so much for coming in on set and joining us here. Rabobank, a senior cross-asset macro strategist.
Thanks for having me.
All right, turning now to meme stocks, the rally fizzling out at least for now, and then this move lower coming on the heels of what has been a massive gain in some of these stocks over the last 2 trading days. Let's get over to our colleague Jared Blickry as a closer look at this movement that we're seeing. Jared.
If it's 2 steps forward, 1 step back, today is the back. And you can't see it necessarily on this board real well until I sort by performance here how much red we have on the screen. And in fact, a lot of those bigger names to the left are simply not participating in the meme trade anymore. But I've been focusing on GameStop and AMC and Cost and some of the other OG members here. And you can actually see these at the bottom of our list. Here's GameStop down 25%, Cost 25%, and AMC down 22%. But what I was writing about in the morning brief today is there's a market difference from what's happening today from 2021, when we saw a lot more retail participation back then. Wall Street was caught flat-footed. They did not expect that. But as happens in human nature, they've adapted. And so now we're seeing this is just really limited to a handful of tickers. Let me show you the 3-day total, because you can see once we account for the prior 2 days, it's a much different picture. GameStop up over 105%, AMC up 83%. But I should note that a lot of these gains have been fleeting, and that's something that does seem similar to the original movement that we had last year. Now, let me just show you the 2-day total here. I'm going to show you some breaks in the action. We've had a lot of volatility halts. And in fact, I counted 16 yesterday. We've already had 4 today. So that's something that stayed with us, kind of interrupt the action. And I see these coming across the terminal. I see these being posted on X. And the question is, how much like this are we going to repeat from 2021? I don't think we're going to have these reprisals the way we did in 2021. And I think the magnitude probably going to be a little bit more muted this time around.
All right, Jared, thank you so much. We really appreciate it, as always. Now, President Biden announcing new tariffs on certain Chinese goods this Tuesday, including $18 billion worth of tariffs on Chinese electric vehicles. Beijing's foreign ministry representative responded by saying that China opposes the unilateral imposition of tariffs, which would violate World Trade Organization rules, and will take all necessary actions to protect its legitimate rights there. President Biden giving his thoughts on how he thinks China will respond when he spoke exclusively with our own Brian Sawsey.
The fact is, China already is what you might say way over their skis on this. What they'll do, I don't think it'll lead to any international conflict or anything like that. But I think they'll probably try to figure out how they can raise tariffs maybe on products that are unrelated.
For more on the fallout from yesterday's announcement and what impact it might have on November's election, we're going to bring in Terry Haynes, Pangea Policy founder. Terry, thanks so much for being here. I want to start on your reaction to what the president was saying exclusively to Yahoo Finance about the idea that this is not necessarily going to boil over into a tit for tat with China. Do you agree with that?
Well, I think you can expect a tit for tat, Madison. The Chinese have never gone without responding to United States tariff action, and I imagine they'll continue today. That's really what the president said between the lines. So, for markets, I mean, what you've got here is a continuation of an existing regime. So, it's not really a big deal. In fact, it probably helps some stocks, autos, and the like. So there's that. But what you're looking at here is a long struggle, and I want to be real careful with markets to say, don't fall for the tariffs noise, which is relatively small. What you're going to see in Washington over the next year or two is a continued move towards shoring up the defense industrial base, and that's really what's behind a lot of the tariffs, politics aside.
So, Terry, talk to us just a little bit more about that backlash, the risk here of an escalation. What exactly could that look like? What are some things that investors should keep in mind when we talk about how it could ultimately impact a handful of these U.S. companies here down the road?
Well, I would look at a combination of things. I would look at firstly market actions. The Chinese will either keep in place or increase tariffs that already exist. They might go an extra mile. I wouldn't know what that would be, but they will at least do a tit for tat, I would imagine. I think it's reasonable to expect that. And beyond that, I think you're going to see geopolitically, you're going to continue to see an upping of pressure in a lot of different places, including the South China Sea, where things are very tense, and markets, I think, don't understand quite how tense they are. I mean, we've got United States Special Forces on an island off of Taiwan right now, just a few miles from the Chinese mainland, and that plus the bases we've already got there, keep the Chinese themselves on high alert and more aggressive. So I think you're likely to see a ramp up in geopolitical risk, not just a market tit for tat.
I'm glad you bring up some of the tensions that we're seeing in the South China Sea. It brings up this larger picture of tension. Brian Sawsey was able to speak with the United States Trade Representative Catherine Tai on the importance of these tariffs in relation to some of those geopolitical tensions. Let's take a listen to what she had to say.
They're significantly out of step with the norms, the standards, and the rules that the international trading system has been built on, which is one that assumes and expects that markets and economies will behave on the basis of the logic of demand and supply. Instead, what we've seen from the PRC's economic policies and practices is a sustained and very targeted approach at establishing industrial dominance in sector after sector.
And it's interesting, Terry, we've also heard the ambassador somewhat switching course, saying that tariffs aren't necessarily inflationary. Do you agree with that?
No, I don't. Neither does anybody else. But she works for Biden, and you got to say that in the White House. The last thing you want to do is politically being caught saying that administration policies are contributing to inflation. So they'll continue to deny that, regardless of whether it's true or not. I also want to say a little bit more directly something that Ms. Tai is alluding to, which is that it's awfully rich that the Chinese are talking about violating trading standards set in the WTO. China today, and China for 20 years, has been classed as a developing economy in the WTO and has fought every effort to reclassify it otherwise. And the idea that the second largest economy in the world is a developing economy is kind of risible on logic, is risible in kind of basic verbal understanding. But this shows you how weak the WTO is and how much China's taking advantage of it. So the United States, from its perspective, feels like it has very little else it can do other than take unilateral action.
Terry, when it comes to this, a lot of people are saying that this is simply symbolic, this move here from President Biden. My question to you is this, obviously coming ahead of the November election. How much do voters care? And why or why not?
Well, I think, Sean, I think an awful lot of the economic narrative is baked in. It's Washington's instinct to want to continue to try to do everything it can to actively help the incumbent, or the other campaigns will attack it. But the economic narrative here is pretty well baked in, which is that inflation is stubbornly high, and more importantly, prices are very high. That hurts the president a lot in a lot of states that he needs to carry, and it is a dynamic that shadows his campaign in a lot of those swing states. So, but it's very difficult. The idea, unless there was a big dive in prices, say 3 or 4 months ahead of the election, this narrative is not going to change, and it's not positive for the president.
Well, regarding the upcoming election, we heard from President Biden and former President Trump this morning that they're willing to debate one another. I'm curious from your perspective, as we see the election start to heat up and become more part of the daily dialogue here, what impact does that have on some of these broader foreign policy moves from the current administration?
Well, it'll keep let me address it two ways. Firstly, it will keep the aggressive foreign policy stance from the current administration up. It will also, they will be perceived by the Trump people as trying to out-Trump Trump. So there will be a lot of tit for tat about toughness on China, toughness on the world economy, toughness on geopolitical risk. So, markets should expect that for the next 6 months. They should not discount it entirely, though, because there's the reality of this is, China policy is among the most bipartisan parts of the United States politics. So that will continue. It's not all just smoke. On the timing of the debates themselves, what is interesting is two things. One is that one takes place before the party conventions, the second after, and outside of the traditional voting. Presidential debates commission. Both of these main challengers see an advantage. Biden sees an advantage in making Trump look weak and all over the place, and hot-headed. Trump sees an advantage in making Biden look old and feeble and out of touch. And beyond that, both of them are succeeding in their own self-interest by keeping Kennedy out. Whose third-party candidacy, I think, is descending into a niche candidacy, but they're still worried about the impact on votes. So keeping him out benefits both of them. That's what you're seeing.
Who's most at risk, Terry?
I'm sorry, say again?
Who's most at risk from Kennedy, just in terms of whose votes he'll likely take more of?
Depends on the state, I think, actually. There's a lot of back and forth about whether he takes votes from Biden or takes votes from Trump. I think it's a little bit of both, frankly. But in an electoral college race where it's down to 7 to 10 states, firstly, and secondly, the individual political dynamics in those states are very different. I mean, Wisconsin and Nevada, let's say, are two very different states politically. You're going to get a situation where a Kennedy candidacy might benefit Biden more by keeping votes away from Trump in one place, but have the opposite effect elsewhere. So it's not easily blown up into a national conclusion.
Terry Haynes, always great to talk to you. Thanks so much for hopping on with us and giving us your insight here this morning. Pangea Policy founder. We appreciate it. Well, coming up, the NFL on Netflix, the streaming giant closer to making its first big sports deal. It's got the deal. We've got the details for you when we come back.
The AI hype is continuing this earnings season as tech giants boosting their spending in the technology. Alphabet and Microsoft reporting big capex spending in their latest results as they fight to win the AI arms race. Now, a bipartisan group of senators led by Chuck Schumer are recommending that Congress spend at least $32 billion over the next 3 years to develop its own artificial intelligence. So what is the next big catalyst for this technology? Joining us now to discuss this is Rich Lesser, BCG Global Chair. Rich, thanks for coming on with us. I mean, we talk all the time about how companies are chatting it up about AI and their earnings prints. It makes them sound good, but it's not always clear how they're actually utilizing it. So what can you tell us that you're seeing in terms of how companies and how many companies are really starting to utilize AI to beef up their efficiency?
So I think we're at a really exciting transition right now, where for the first year or so through most of 23, many companies were focused on just understanding the technology and what it could possibly do. I think now more and more companies are realizing there's a major opportunities here. And the challenge is, if you take a 1,000 flowers bloom approach, you don't translate anything into real outcomes at scale. And so we see companies more and more focused on what are the key outcomes that you can drive that meaningfully move overall business performance. And if I just give you a few examples of those, in the pharma R&D world, we're seeing people use it to actually create new molecules that may be equally effective, but actually safer because they're more targeted. To take development and regulatory processes that are filled with paperwork and reduce the time to generate reports and produce protocols by 80%. To take claims processing, which is, normally takes over a week to do, and take it down to hours or a couple days. To take customer service and really empower their customer service reps to be much more able to spend time focusing on the customer and less time having to read and memorize the manual. And those are all, depending on which business you're in, really tangible opportunities that drive both greater customer value and greater financial impact. And that starts to get pretty exciting for businesses.
Rich, in terms of what CEOs need to communicate to their employees, to shareholders if they're a public company here, in terms of why this AI investment makes sense, what investors want to see, what are the critical questions that they need to answer at this stage of the cycle?
So with investors, we would argue that companies need to highlight that they are not just there to say they're doing generative AI to get to nifty pilots and shows at investor meetings. They're there to meaningfully improve business outcomes, which is often about transforming entire business functions and processes. Sometimes it's about creating entirely new business models to drive top line growth. And that they are going to learn, but they're going to learn by doing, not by creating a lot of paper. And I think that that's what investors want to hear. And then within a relatively short space of time, they should get to see tangible business outcomes. I think with employees, it's the essential part of the journey, actually. We have this framework in BCG that we talk about all the time, 10, 20, 70. 10% of the work is on the algorithms. 20% of the work is on the digital and data platforms. 70% is on people, process, org, leadership, culture, all of the things to go from having a very interesting capability to actually deploying it. And there's a huge effort around reskilling. There's a huge effort around changing how people view the technology and learn to work together with it, how employees work together across functions, because AI can actually create massive value when you stop looking at it in a very narrow lens and look at it in a broader based way. And that requires an enormous amount of investment in people. And we see it played back. The companies that are leading in deploying AI are actually getting higher scores from their people on Glassdoor, are actually viewed as more positive places to work, places that care more about their people and wanting to invest in their skills, not just for the job they have today, but for jobs they might have in the future. So there are different messages, but they're both critical messages for investors and for employees.
Well, and I'm interested in this, Rich, because in your survey print, you've got a mix of consumer sentiment surrounding AI. Did it surprise you that consumers were a little bit more positive than one might think about something that everyone talks about as this scary elephant in the room that's going to take everybody's jobs?
Look, I think we all wear three hats. We're consumers, we're citizens, and we're employees. And that's the vast majority of Americans, and sometimes students. It depends on what ages we're talking about. But I think if you're a consumer or frankly a student, you look at this and you say, I should be able to get information more easily. It should be able to navigate my world. It should be able to help me distill what's important and what's not. I think if you're employees, it's a mixed feeling. These are skills you want to learn. You know where the world is going. But of course, you worry, will AI eventually replace my role or my job? Or will the skills that I need to acquire be skills that I can acquire? And then as citizens, of course, there are concerns around misinformation and risks to critical infrastructure or other things. And so I think each of us wears multiple hats. And I don't think it's surprising that people view this AI world differently depending on which hat they're wearing.
Makes a lot of sense. Rich Lesser, always great to talk to you. Thanks so much for hopping on with us this morning. Global Chair of BCG. We appreciate it. Let's get to some trending tickers. We had breaking news out just minutes ago. Netflix pushing further into sports. The streaming giant announcing a deal to stream 2 NFL games on Christmas Day. This marks the first time Netflix, has licensed the rights to a premier sport and the first time it will show live football. Yahoo Finance's Ali Canal joins us now with the details on this. Ali.
Hi, Shauna. Yeah, this is a big announcement, and it's a little bit surprising, too, especially considering that Netflix has historically said it wants to avoid investing in traditional live sports. But clearly, this announcement is a big deviation from that. Co-CEO Ted Sarandos, his quote was always, "We're not anti-sports, we're pro-profits." And here are the details of this deal. They will air 2 doubleheader games Christmas Day. Now, it's a 3-season deal, so moving forward, they said they will stream at least 1 holiday game per year as part of that deal. According to Bloomberg, the company will pay around $150 million per game. But like I said, this is something that we really haven't seen from Netflix. They've leaned into sports adjacent content, airing different types of programs like The Quarterback, Formula One, Drive to Survive. We've seen them dip their toe into live programming. They aired a live version of the Love is Blind reunion. We saw the Netflix Cup, which was that celebrity golf tournament. And they recently did announce a partnership with the WWE that will bring the WWE's flagship program, Raw, to the streaming service beginning in 2025. But even then, Ted Sarandos said that the inclusion of that program did not signal a change in its overall sports strategy, although analysts across the board have said that Netflix is not going to be able to avoid this. Sports is really the last frontier when you think about the streaming battle, and Netflix has consistently been the leader of streaming, so it makes sense that they would get involved in the NFL in some way.
Well, I'm interested in the impact this might have on their ad tier offerings because live content equals ads in my mind. Does this indicate that ad tiers may not become an option for Netflix users anymore?
That's a really good point, and the company is hosting their upfronts presentation later today, so I'm sure that's going to be a big question mark for advertisers. I mean, it's certainly an attractive opportunity for advertisers. You think of something like the Super Bowl, where you have ads just flooded, and that is where people really watch a lot of the advertising on there, so that could be a unique opportunity. We know that Amazon Prime, they aired the Black Friday game, and they were able to drive a lot of traffic through advertising, through product placements. Maybe that's something that Netflix could experiment with as well. But I agree. I think we're going to have to wait and see what details emerge from this. But, you know, in linear TV, you have ads in between games, so it could be the same.
It's a huge opportunity, you would think, for their ad business.
Absolutely. Well, Ali, appreciate it as always. This is a really exciting story, so thank you for covering it and bringing it to us here. And it's been quite a busy week for Google as well. The tech giant unveiling a slew of generative AI products at its I/O Developer Conference in Mountain View, California on Tuesday. Those include its Gemini Live Assistant and updates for its Android and Workspaces platforms. So what have we learned from one of the biggest tech events of the year? Yahoo Finance tech editor Dan Howley is live at the conference to explain. Dan, thanks for joining us. What do you have?
Yeah, Maddie, look, there's a couple of things that I think are worth looking at here. And really, it's kind of a full reinvention almost of Google itself as kind of the new leader of AI, or at least that's what they're projecting after they kind of lost that crown to OpenAI and Microsoft in 2022, 2023, where we saw those companies really just take off as far as generative AI goes. And then Google kind of stumble out of the starting blocks. They had that Bard launch that wasn't that great. They recently had those issues with its image generative software, but now coming out of Google I/O, it looks like they're back in a leadership position. They announced big changes to search, where they're going to have what's called an AI overview, kind of a short description or short answer rather to the queries that you have, along with links to those cited information sources directly below those. So it's going to be a completely different look for Google search going forward, at least in the US for now. And then they said billions of people by the end of the year. There was also a really interesting product that was previewed. It's a prototype called Project Astra. And it's really this kind of new form of AI assistant that uses both voice, live stream video from your phone. So if you open up your camera and you're looking at what's going on in front of you, it's able to interact with what it sees through your phone's camera. Really interesting stuff there. In fact, as I was walking around the I/O floor, Google co-founder Sergey Brin actually walked out of a booth checking out the technology. And I asked him, what his thoughts on the kind of rivalry with OpenAI is like, and what he thinks of the company's new GPT-4o model, which just came out the day before I/O, coincidentally, I guess. He said he hadn't been able to try it yet, but that he thinks this Project Astra would have been great for Google Glass, that kind of ill-fated wearable that came out about a decade ago. He said it was probably 10 years too early for that. But when you look at overall what Google is doing here, they're just infusing more generative AI throughout all of its products. And as I said, I think that's their way of really trying to project the fact that they are back on top as an AI leader and not kind of the second fiddle to OpenAI and Microsoft. Still, Microsoft has their Build conference next week, and you can guarantee that they're going to announce some kind of generative AI offerings likely tied to OpenAI.
All right, Dan, we're going to have to leave it there, but thank you so much for joining us as always and bringing us your on-the-ground reporting. We appreciate it. We are also watching the energy space. Wolf Research downgrading SunPower to underperform, and that's down from the previous rating, which was at peer perform. The stock down over 29% here. Now, Wolf Research saying that this stock is the most extreme example of the meme stock resurgence. And Shauna, we know this is a heavily shorted stock. I was just taking a look at some of the data here. Short interest on this name climbed 96% on Tuesday, but the rally in SunPower allowed this name to erase all of their 2024 losses. And this comes as the entire solar equipment stocks space is struggling with higher for longer interest rates, with the fact that individuals who were going to switch to solar power largely did it during the course of staying at home for a couple of years during the COVID-19 pandemic. And it's gotten a lot more expensive to do it with those higher interest rates. So it's interesting to see the stock continuing to be a meme name.
Yeah, it is. And I think that this just highlights what has been going on in the market the last couple of days. Some of these names not trading within their fundamentals. We're certainly seeing that. And that's essentially what this analyst is calling out in this downgrade here that he does have on this name, basically saying that right now he's downgrading the recommendation to underperform because it needs to come back to reality once the squeeze, which we have been seeing play out in the markets over the next 2 days, starts to subside a little bit. He talked about some of the headwinds or some of the challenges that are ahead here for the industry, specifically for SunPower. What I found was pretty interesting here within this note was that he called out the outlook for rooftop solar in California specifically, and why he mentioned this as such a headwind for SunPower versus some of its rivals, or more of a challenge, I should say, for SunPower versus some of its rivals, is because of their exposure to California. They have a greater exposure to California than some of their other peers out there, so that could put them at some risk here, at least in the short term. So you mentioned higher rates, you mentioned the uncertainty surrounding the sector as a whole, and obviously this downgrade comes on the heels of what has been pretty astonishing rally for this name and many names over the last 2 days. You're talking about a gain of more than 90%, you said, in one trading day, more than 9% in 2 trading days. So it's no surprise that there's analysts out there saying that, hey, this does not make a heck of a lot of sense, and we got to see this return to reality at some point.
Where is the reality, Shauna? Because it's still, I guess it's coming in for the AMCs. It's starting to come in for GME as well, but it's just fascinating that we're still seeing the retail investors pushing up these meme names here. Well, amidst a higher for longer environment, you may want to take your cash from the sidelines and invest in, get this, municipal bonds. We're going to have more on that coming up next. Stick with us. do check of the markets here, sponsored by Tasty Trade. S&P 500 hitting all-time highs as traders start to price in an 80% chance of a Fed rate cut by the September meeting. You're looking at a lot of green across your screen here, but I do want to point out this bump up that we saw in the S&P 500, and this is where we got that little all-time high. Look at that square I just drew. How fun. So that is why we're seeing a little bit of growth to the upside in markets this morning. It's really driven by that CPI print. Questions remaining about whether or not the market should be as excited as they are about that print, but we are seeing that movement nonetheless. We're also seeing a little bit of a sell-off in the bond space with the 10-year note hitting around 4.3 this morning. Some traders were pricing in a 4.2 handle on the 10-year note. We're not exactly hitting that level, but still seeing a little bit of a sell-off in the overall bond space, particularly toward the long end of the curve, Shauna.
All right, Maddie, thanks for breaking that down. Let's talk a little bit more about the action that we are seeing play out in the bond market right now. Treasury yields are moving lower this morning following that CPI print that we got out this morning, showing that inflation is in fact cooling. It's allowing investors maybe to gain a little bit more confidence that the Fed will likely or could potentially cut rates before the end of the year. Let's bring in Matt Egan. He's Loomis Sayles, head of full discretion team, joining us now. Matt, it's great to see you. So talk to me about how you're looking at today's print, the reaction that we're seeing within the bond market, and whether or not that makes sense to you.
Well, the numbers came in pretty much more or less right on the screws, and I felt like the market wanted to rally with that type of print, and that's what we gotten. It did show continued deceleration in the inflation, so there's some good news here. There's also some not so good news. We're still seeing that super core, that so-called super core services, still showing that inflation is still rooted in the system, and it's tougher to extract ourselves from that higher level, higher than target level inflation that Fed would certainly like to see. So it's stubborn. Our expectation is that it will continue to trend down this year, but it's been slow going for sure.
Okay, so talk to me about this move that we're seeing in terms of traders pricing in an 80% chance of the Fed rate cut happening by the September meeting. That's obviously a big change, and we're seeing a lot of movement, particularly on the front end of the curve here. I look to the bond market to give me sanity when equities are overreacting. So what gives from all this movement we're seeing?
Well, this is a case where good news for the bond market is good news for the risk trade. And that's because, there's an expectation that the Fed will indeed be able to ease by before the end of the year. And that was called into question not so long ago because, as you know, the economy has been very resilient despite all of these rate hikes by the Federal Reserve. Inflation has been kind of sticky on the downside. So there's a little bit of a relief rally to getting a print that's showing some continued deceleration. I think there's, we'll take a big step back here. To think about it from broadly, both stocks and bonds, there are some structural factors here as well as cyclical. On the structural side, in our view, we flipped from a regime where we had very low and stable inflation. This is leading up, past the GFC, leading up to the pandemic. And for the last several years, we've seen some emergence of some macro structural factors that on the structural side will keep inflation perkier than it was. So more volatile, what I would say is unstable. Now, that's the structural feature. Cyclically, and what this print shows is that we're still, so if you think of CPI sort of in a, running in a sort of sawtooth pattern, a cyclical pattern with the economy, we're on the trend lower, coming down one of those saw teeth, if you will, and we're bottoming here. So from a cyclical perspective, there's still some more to wring out. But what I would say about this is, given the structural factors here, we have to keep in mind this is probably going to be a very shallow rate cycle. So once they do cut, there won't be that many more cuts that come. And that will put a limit to how much lower yields can go from here, particularly on the longer end of the curve.
So then, Matt, what are you telling clients then that means about positioning and where you're seeing that opportunity now?
Right. So for very simplistic, when you think of bonds, an individual bond or a bond portfolio, there's really two broad types of risks that you have to think about, right? So you buy bonds for income, stability, and ballast in your overall portfolio. Today, you're getting really decent amount of income, certainly a lot better than we saw, not 5 years ago. So all that's really good news, and I think bonds can really sit in your portfolio and function very well. But when you look at a particular bond or portfolio, you have to think about reinvestment rate risk and principal risk. Now, when rates were coming down for those long 30, 40 years leading up to, this spike in inflation, your key worry was reinvestment rate risk. What do I mean by that? You get a coupon or principal and you'd have to roll it into a lower level of yield, a lower level of income. And that's really painful over time. We think that's behind us, and that's a good thing for bond investors. Now, we think over time, over a longer period of time, you'll be able to reinvest your lower coupons into a higher level of yield. Everybody likes that. They want to earn a higher level of income.
Right.
The challenge that we face in this structurally higher and unstable inflation regime is principal risk. So for a longer dated bond, there's so-called notion of what is the duration of a bond, which is a statistical number that's quoted in years. And the longer a bond is, a lot higher the duration, the more sensitive it is to interest rate volatility. So a 30-year bond will have a very high degree of risk. So we're advising clients to creep out the yield curve to lock in and avoid some of the near-term cyclical reinvestment rate risk. So in other words, if you stay too long in the 1-year T-bill, it looks really attractive at 5+% yield. But as the Fed gets going, that's going to go down into a 4% and so on. You're going to reinvest at a lower level of yield.
Right.
So you want to move out the yield curve to lock in, the high 4s, mid 4s that are available out the yield curve, but just not too far. So when you're looking at a bond fund, pay attention to that duration. If you're bullish on rates, you think inflation's really come down,
right,
go for a higher level of duration and vice versa.
All right, Matt, we're going to have to leave it there. Thank you so much. Really appreciate it. That was Matt Egan, Luma Sales Head of Full Discretion. Thank you. Well, $6 trillion in cash is parked on the sidelines as investors reap some of the benefits of those high interest rates. But as rates continue staying higher for longer, there's one investment you might be overlooking. To break it down for us, we have Dan Close-Nuveen, head of Municipals, here in studio. And thank you so much for coming in here with us. I just want to start by doing like a big step back for our audience. Retail investors, they may not be investing in municipal bonds at the moment. So what do they need to know about just dipping a toe in and looking for opportunity?
Well, first, thank you so much for having me here. This is fantastic to be in studio. As we're talking to our high net worth and our retail investors right now, taking a step back, we are at the highest level of interest rates to start 2024 in the municipal bond market since 2011. And we've only backed up 40 basis points. So it's I think, a much better environment than we even had at the beginning of the year. Consider if you are in the highest tax bracket, you're earning more than 6% on a taxable equivalent basis for an intermediate AA portfolio and more than 9% on the high yield side. So we think the opportunity is there. This is an opportunity going back 2-3 years ago that there really wasn't much income in fixed income. And with this backup in rates, particularly since the beginning of the year, now certainly since the last FOMC meeting, we've had a bit of a rally. We think the opportunity is there, and we think certainly with the Tax Cut and Jobs Act expiring at the end of 2025, there is the prospect for higher taxes. And with the prospect for higher taxes, we think the muni exemption is worth just that much more, given that we're likely going from a 37 to a 39.6% tax bracket. If we have a divided Congress, if we have whoever comes into the White House, this automatically extends, and you have the prospect for higher taxes. So I think that opportunity set is what we're looking at, and we're certainly seeing this as a better opportunity set than really anything else in fixed income, given what the rates are on a tax equivalent basis.
Dan, what does the setup look like a little bit more short term? We spent so much of today talking about the CPI print that we got out this morning, what exactly that means for the Fed in terms of their fight against inflation, what it ultimately means for rate cuts. Are you closely watching that, and why not?
We are closely watching it. Today was surprising in that it was a good inflation number in that it actually came in at expectations. So, you consider the last 3 reports where the consensus was wildly different from where the print came in. What we're most closely watching is the shelter component, which really showed some signs of rolling over at 3.5% month over month, and also core services, and that also moderated. So a combination of, I think, a really good CPI report, and again, good as just hitting expectations. The PPI revisions from yesterday, a soft retail sales report, all that has been very good for fixed income. And if you consider since May 1st, the last FOMC meeting, we've rallied 25 basis points on the 10-year. So munis have done really well, and they've done well not just because of what we're seeing on the broader fixed income side, but we're having a lot of spread compression with municipals because I think investors are looking at municipals and saying, it is really good from a credit perspective. All the money that came in from COVID is on the balance sheet of state and local governments. We're seeing collections really do well, especially at the local level in sales taxes. And all that's really come together with very easily digestible supply, a very favorable environment with broader fixed income. And we're having a great year compared to just about anything else in fixed income. So I think there is more to come. And I think as investors really start to dial in on the TCJA, perhaps going in and not being renewed, we're going to see more interest in the tax exemption and what it could do, especially for high net worth investors.
In our final minute here, where specifically is the opportunity within munis?
Sure. At Nuveen, we see two specific spots. By sector, we're really focused in on local general obligation bonds. We're seeing very good property tax collections, which is what basically underlies the repayment of those bonds. We're seeing very good fundamentals from any of your essential service monopolies like water and sewer, but specifically to our positioning and different than what you're seeing in the broader treasury curve is the municipal curve is upwardly sloping. And so you don't have this funkiness from 10 to 20 years being kinked, from 20 to 30 years actually having a downward slope. You are getting paid more and more for every year you take in the municipal bond market. So we're really encouraging our investors to go out beyond the 12, 13-year part of the curve, get paid for taking a bit of yield curve risk. And if the Fed does indeed cut, as is expected after today's CPI reports, 2 times in 2024, it's just going to add capital appreciation to the story.
Dan Close, we'll leave it there. Nuveen's head of municipals. Thanks so much for hopping on.
Thank you so much for coming.
I keep right here on Yahoo Finance because stocks are almost just about an hour and a half into the trading day. We're looking at gains across the board. You've got the Dow up nearly 200 points. You've got the S&P up around 0.7%. We've got more on the market moves when we come back.
BMO Capital Markets raising its S&P 500 year-end target, now the highest on the street. The firm is forecasting the index to end the year at 5,600. That is up from 5,100. Now, in that price target increase, they're citing the strength of the market momentum as a reason for raising that up. And it's interesting because this was kind of a holdout. BMO Capital Markets, typically a more bullish voice on the street, particularly from the individual raising the price target here to 5,600. It took them a long time to go from 52 to 56. And it's interesting that it comes right after this hotter CPI print as well, though I'm sure it was in the making prior to this print, because there is this question mark out there about whether or not today's print actually does indicate a disinflationary trend. But the biggest on the street, 5,600.
Yeah, you know, it's not a huge surprise. When Belsky was sitting here at the desk with us not too long ago, a couple of weeks ago, he was sitting there with the 5,100 price target and sounding very bullish and optimistic. And I asked him, I know he wasn't going to tell me, obviously cannot for legal reasons here, but I asked him, I was like, well, it sounds like you might be raising your target pretty soon. And it very much ties into the bull case that he laid out with us here in Yahoo Finance several weeks ago. And he was talking about just the strength that we are seeing within the market, especially at this time. And it's really defied many of the expectations that we had going into the year. And also essentially the fact he made the point that consider that investor expectations and Fed policy guidance have now essentially come aligned versus the significant disconnect that existed at the beginning of the year. So the fact that we are seeing more of the fact that it seems like the market is coming around to realistic expectations here, and what we could see from the Fed giving more of a reason to be bullish and see more upside here from these current levels. And we certainly are looking at gains today.
Yeah.
All right, well, let's do a final check of the market and those gains that we were just talking about. You got the Dow up just around 200 points, and you got the Nasdaq up about 0.8%.
Now, coming up, wealth dedicated to all of your personal finance needs. Our own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and, the tricks that you need to grow your money. On today's show, the latest read on inflation dropped today. We dig into the biggest areas where inflation is lingering and conversely, where pressures are easing. And speaking of inflation, shelter continues to be a recurring hurdle for consumers. We'll talk to an expert and get 5 tips to make home buying easier. Plus, student loan headaches. The federal interest rates for student loans climbing to its highest in more than a decade will provide prospective students with the tools to make college a little bit more affordable here. All that and much more on today's show. But let's kick it off with a look at the consumer, you and me out there. We were muted in April. Retail sales coming in flat for the month versus the growth expectation of 0.4%. That's according to the Commerce Department here, as you're seeing the all items index data, plus the data furthering some concerns about the strength of the consumer as interest rates remain at a 23-year high. Digging into some specific categories here, the biggest declines came from non-store retailers, sporting goods and hobby stores, and motor vehicle and parts dealers. But Michael Pierce of Oxford Economics says the downshift here in spending growth in April can be entirely attributed to strong showings in March, which he thinks is a combo of Amazon's big spring sale and an early Easter, both of those boosting spending in the month prior. We'll continue to monitor the strength of the consumer as the Fed considers inflation and the trajectory of interest rates as well. But turning now to today's CPI, the Consumer Price Index report, and it showed inflation came in lower than expected on a headline basis. That means overall, the monthly change in prices paid by you, the U.S. consumer, came in a little cooler than what analysts had anticipated and economists out there. And we're seeing some moderation in the level of inflation in April versus March. So we want to dig into 3 areas where we're still seeing some sticky prices. And here with more, we've got Yahoo Finance's Alexandra Canal. Hey, Ali.
Hi, Brad. Yes, unfortunately, there are still areas where prices have remained elevated. Shelter and gas, certainly 2 of the biggest contributors to overall inflation. But we also saw sticky prices in apparel. So our shopping trips becoming a bit more expensive as well. But I want to kick things off with gas. Those prices at the pump just not letting up. Gas prices rising 2.8% from March to April after climbing 1.7% the previous month. Now, the good thing here is that economists have said gas prices have actually fallen in May as geopolitical risks to higher oil prices have eased, at least for now. So that should help the inflation picture moving forward. Besides gas, shelter has also been consistently under pressure. The index for shelter rose 5.5% on an annual basis. This was a slowdown from March, but shelter is still the largest factor in the monthly increase in core prices. Now, those are prices that exclude the more volatile categories like food and gas. Meanwhile, the index for rent and owner's equivalent rent each rose 0.4% on a monthly basis. And for reference there, owner's equivalent rent is a hypothetical rent a homeowner would pay for the same property. These increases did match what we saw in March. So shelter, gas, these are 2 categories you've heard me consistently harp on as we've gotten these inflation reports, and obviously still a big problem area for consumers.
I mean, it's not just these big categories that saw increases last month. You also mentioned our shopping carts becoming a bit more pricey. So what did we see there?
Yeah, so apparel is one category that jumped out to me. Prices there rising 1.2% month over month after just a 0.7% rise in March. Now, this was by far the largest increase we've seen in this category so far this year. Besides apparel, there were other categories that also saw notable upticks in prices like motor vehicle insurance, medical care, personal care. So again, all categories that we as a consumer often touch every day of our lives, which is why the consumer has been so squeezed. And I think the retail numbers that we saw this morning really emphasize that point.
Yeah, a lot to continue to dive in on this. Ali, thanks so much for teeing up our next conversation. And one of the elements of inflation Americans plagued by surging prices over the past 21 months are still feeling strains in their wallets. Consumer prices rose 0.3% last month, 3.4% over the prior year in April, a slight deceleration from March's 3.5% annual gain in prices. And the cost of everyday necessities are still relatively too high for consumers liking here. And one of those costs that keeps ticking higher is childcare. The latest CPI print showing childcare costs are up nearly 2% in the last year. For more on this, I'm joined by Tim Shin, who is the Greenlight co-founder and chief executive officer. Great to have you here with us. Let's dive into this real quick, Tim, as we think about what's contributing most to those childcare costs.
You know, I think it's because childcare these days, there's so many things included in that, you know, not just maybe the agencies or someone actually taking care of the child during work hours, but there's so much more that parents have to pay. If you look, like just even a survey that Greenlight did last month, 76% of parents say they're very stressed about money. And interestingly, also 3/4 of Gen Z teens are also stressed, feeling that stress about money. I think it's just because it's cutting across a lot of the inflation is cutting across a lot of categories that hit families in particularly hard, whether that be gas, groceries, clothing, all of the categories you just mentioned.
And so we're taking a look at some of the types of childcare costs that we're keeping tabs on, but there are a ton of ancillary costs within all of these as well, whether it be baby food or whether it be apparel for school or writing a check that they give to the lunch in order to make sure that they're getting lunch at school. All of these things considered, it shows up in different ways here. Are there areas where it seems like in this childcare realm that there are starting to be some more concerted pushbacks on prices?
Yeah. I mean, I think that families are, you know, they're doing the best they can. They're actually getting creative, you know, and trying to find ways to save money. I think that it's great to see the cases where parents are kind of involving the kids in helping to save money. You know, by, hey, let's eat out a little less. Let's all take a bike ride to the grocery store or take the subway if you have one available to you. Try to save some money, but then also have kind of a benefit, like whether maybe it's the summer vacation, you know, so, hey, we're going to take a family vacation this summer, but we need to save for it. And so you kind of all are in the same boat together, and you are looking for ways to save money. And if you have a savings account kind of tied for that goal, if it's a summer vacation, for example, you know, make sure everybody in the family can see the balance and everybody can contribute to it. Something like Greenlight would enable that. But that way the kids can help the parents with it, and actually be learning some things too along the way about budgeting and, you know, spending what you have, living within your means, wants versus needs. There's a lot of good things that can come out of this kind of a difficult period of time where kids can really learn some things that'll be quite helpful for them when they're adults out on their own.
You know, it's really interesting, especially as we think about the family formation among millennials and what is anticipated there over these next few years, particularly. And that could mean a boom as well in the number of children that are expected to be entered into the broader either childcare services or educational front as well, and schooling, all of these considered. How do you think that will change where consumers are prioritizing certain elements of education versus childcare and the moderation that's expected there?
Yeah, you know, it'll be interesting to see what happens. I wonder, you know, will some people start to look at, you know, is it worth having both parents work, for example, given all of the expenses associated with raising kids and taking care of kids? Will they come up with some creative solutions? You know, that's the thing about Americans is we will always creatively solve problems. And so it'll be interesting to see what happens, but I think you're right. I think there will be some changes. People will find ways to save money, and if certain categories of expenses are too high, then, you know, people will look for alternatives. They'll look for other ways to kind of, you know, meet their needs, even if it means kind of doing something less than they used to. But maybe it's just become too expensive to continue to buy that kind of thing or go to that kind of place. It'll be interesting to see what happens.
All right, you're telling me to get all of my concert and experiential economy visits out now. Tim, I get it. Thanks so much. Tim Sheehan, who is the Greenlight co-founder and chief executive officer. Appreciate the time.
Thanks, Brad.
Certainly. Well, more Americans are carrying a sour tone on the economy, even as the pace of inflation weakens. Consumer price increases moderated somewhat in April, rising 0.3% month over month, as revealed by data from the Bureau of Labor Statistics. So, what does the latest inflation data mean for your investment portfolio? For more on this, joined by good friend of the show, Lee Munson, Portfolio Wealth Advisors President and Chief Investment Officer. Okay, so what is the inflationary environment play for people's portfolio out there, Lee?
Well, let's just note all this bad news and inflation. The S&P 500 made an all-time high today, right? We're almost at 5,300. So obviously, this news today is good for the stock market, right? Because it suggests that we might get some cuts. If you look at Fed funds futures and look at the betting markets that bond market participants do, we're not really expecting a cut until later this year. Most of the statistics or the spread is all about after the election. So we know that the inflation, destroying inflation, it's just delayed. It's not completely off the table. And when the stock market prices 6 months forward, and that's what I think that everybody has to realize. Nobody cares about what happened 6 months ago. Nobody cares what happened 30 days ago. I only care about one thing. What I think the next 12 months of earnings are going to be on the aggregate S&P and all the asset classes that I follow, and all those are going up. The only major asset class that I follow that's going to have declining earnings growth going into next year is the Nasdaq 100. But the S&P is supposed to grow, large value is supposed to grow. Look at Japan. It's going to go from a negative EPS to a positive EPS over the next 12 to 18 months. And all those stocks are increasing their dividends. So there's a lot of good stuff out there because we all expect, I think on Wall Street, that inflation will moderate just at a slower pace. And today, the market has voted what they think about the situation, which is we go up in asset prices.
When the market finally gets what it wants in the form of that first cut and then the pacing of cuts thereafter, where are some of the outperformers, or where does that even perhaps initiate a pivot?
Well, I'm not sure that there's necessarily a pivot. I'm not sure that once rate starts getting cut, that you're going to have these clear things that are going to start working. What I think that we have to think about is look at what the sectors where we have an increasing amount of earnings. Now, obviously, in the past, we have this expectation that big tech companies or private equity tech firms that need money cheap, that they're somehow going to do much better when the Fed starts cutting rates. But I would caution everybody, nobody's saying that the Fed is going to go back to a zero rate interest policy. That's not really the situation. We're just trying to get back to maybe 3%, 2% Fed funds rates. So I think that what that means for stock portfolios, there's a high likelihood that as soon as we see that pivot, we're going to see more of a broadening out of stock participations and a more broadening out of what stocks are participating in a rally going into next year, rather than going back to the mid-teens 10 years ago, where it was just large growth stocks that make a lot of revenues, maybe don't make a lot of profits, and live off of cheap money. So I think we're going to see a very different dynamic than we did pre-COVID.
And let's also draw in the employment situation here too, because a lot of what we're seeing in terms of the inflationary measure and how much the resiliency or the health of the consumer continues to remain positive, that draws back to what their employment prospects look like. How are you measuring that and playing that as a portfolio strategy?
Well, I love the ECI, the Employment Cost Index. I talked about it with you. I think it was in January we were yapping about it. We've got to see that ECI, which is the total cost of hiring a new person. It's a great index. It's kind of like my secret sauce. I got from some great bond analyst. I forgot her name. Sorry, I'm not giving her enough credit. The ECI is still very stubborn, is still very sticky. And so I think it's good. First of all, we have some of the lowest unemployment we've ever had. That's why we're not getting a recession, is because labor is tight. But as we move forward, the question is, are those labor costs going to come down? I'll tell you, today's print suggests that services are sticky and labor costs are not going to come down. And if we have an event in November where we start having mass militarized deportations because a Republican wins a unified government, we're going to have even more problems with wage inflation. And as much as people want to talk about Silicon Valley and tech cutting jobs, those weren't coders and engineers. Those were a bunch of HR professionals and salespeople and sort of in the non-tech oriented areas of tech. And they all got jobs, right? So we're not really seeing these big layoffs. So everybody who wants a job basically has a job right now. And for those who are unemployed, they've got to start upskilling their work. And I think that that's just the cold hard reality. This is a slow burn. This isn't like a new idea.
All right, making generative AI our friend, I suppose, in the age-old debate of friend or foe. Lee Munson, Portfolio Wealth Advisors President and Chief Investment Officer. Lee, good to see you.
You too.
Thanks. Coming up, housing hurdles. Mortgage rates are high and shelter costs remain sticky, as we were talking about in today's inflationary prints. We're going to bring you the 5 tips that you need to know to make the home buying process just a little bit easier. That's next. Let's do a quick check of the markets, sponsored by Tasty Trade. Taking a look at the U.S. major averages, the Dow up by about 0.7%. We'll round that off to the S&P 500 also up by about 0.9%, and the Nasdaq Composite up nearly a full percent, 160 points added on for the tech-heavy average here on the day, roughly 2 hours, almost 2 hours into the start of trade. Well, mortgage rates are averaging above 7% for the past 4 weeks, according to Freddie Mac. High rates and high home prices are weighing on buyers and builders. Here with the latest on the housing sector, we've got our very own Danny Romero. Danny, how are home builders reacting to mortgage rates right now?
Brad, home builders are not feeling confident about the housing market, especially that mortgage rates have stayed above 7%. The index that tracks home builder confidence came in at 45 points in May. That is 6 points lower than the April's figure, the National Association of Home Builders reported. Remember, any number above 50 indicates that builders view conditions to be good rather than poor. So this really highlights how builders and also buyers are feeling right now in this higher for longer environment. Now, one of the points that I want to point out from this report is that 25% of builders actually cut home prices to boost sales up. Another thing that was interesting was 59% of builders used incentives to also move some sales and inventory around, Brad.
So rates remain elevated as we're taking a look here on the screen at. What about housing inflation? What are we seeing there?
Brad, shelter disinflation is on track, according to experts. And there are 2 points in the April's inflation report that really highlight this. First is rent, came in at 0.3% month over month. That was the smallest rise. And also experts tell me that that really reflects and resembles the pre-COVID days. Another encouraging aspect from this report really is owner's equivalent rent. That is OER. That's the hypothetical rent a homeowner would pay for the same property. That remained unchanged at 0.4%, but the fact that it has softened within the month is really encouraging, experts have been telling me. So housing inflation has slowed from its peak of 8.2% a year ago, but yes, only to 5.5%. But one economist from Oxford Economics said it this way: we have to be a little bit more patient than expected, especially that CPI lags real-time rent data, Brad.
All right. Danny, thanks so much for breaking this down. A lot of commentary specifically on shelter here today, and we're going to continue that conversation as shelter remains a sticky area of inflation, rising 0.4% in April, and specifically rent costs remain a big problem. And that aligns with a new Bank of America survey, actually, that reveals many prospective home buyers fear the long-term consequences of renting, including 72% who worry that rent increases could affect their current and long-term finances. Here with more, we've got Matt Vernon, who's Bank of America's head of consumer lending. Great to have you here with us. Let's dive into that. Where, and as we're kind of really just grasping some of the data in this survey here, where are you seeing some of the sentiment line up right now among renters?
Yeah, interestingly enough, as you already set up, most renters in the survey responded saying that ultimately, while they believe in the short term that renting may be a good decision based upon the current environment that your previous reporter talked about, they also believe that they're missing out on long-term financial success that homeownership ultimately brings. So they're making a short-term decision, but they know that they're sacrificing potentially long-term. And in fact, 80% of those surveyed that are renting today believe that they will 76% will buy within 5 years. Thanks for throwing that up there.
And you know, and as we're taking a look at the stats, it comes to mind that there are a lot of potentially a lot of renters out there that are not actually paying the market rate. They're paying a different rate that the landlord is willing to give them in order to make sure that they don't have to, report something different at the end of the day. So the gap or the delta between those two prices, what's actually being paid versus what's being reported, where is that going to start to eventually show up in easing some of the shelter costs that economists that we speak with in our program are continuing to cite as one of the stickiest and most troublesome parts of the inflationary picture?
Yeah, hey, it's all supply and demand in many respects, whether we're talking about rental inventory or we're talking about home inventory. And until we begin to see that inventory grow and ultimately supply and demand become more balanced, we'll still see that gap, although there are some early signs, as I think the previous reporter stated, that we're beginning to see that number come in.
Additionally, when you think about the number of plans for purchasers out there, how many of them, either based on the survey or based on what you're hearing in the pulse of potential home buyers out there, are just waiting for a wave of interest rate cuts right now?
Yeah, I think that's on everyone's mind. And it's both the existing homeowners and that may have a rate that is in the 3s and even 2s and 4s. And then the prospective homeowners that are looking at that 7-handle rate that you talked about. That said, the mortgage market is expected to be close to $1 trillion from a purchase perspective this year. And our survey says that folks are still believe in the dream of homeownership, that ultimately they understand that rental may be short term, but the sense of permanence of a home, of a financial accomplishment of owning a home, is still alive and well with consumers today.
What can consumers do, prospective home buyers do, in order to get ready and ready themselves in order to make sure that they can jump on an opportunity once the opportunity seems right?
Yeah, Brad, it's a great question. It's primarily 4 to 5 things. First and foremost, be cognizant of your credit score and ultimately do things to prioritize and improve it. Having a good credit score is not only good to get approved for a loan from a lender, it also can provide benefits from a rate perspective, which would be very important in the rate environment that we're in today. Second is save. And you've got it up on the screen. It really is important to create a budget, pay yourself, and ultimately save for that down payment and unexpected costs that come with home ownership down the road. Debt is a big thing. Lenders look at the debt to income and the ratio between the two. So minimize debt and ultimately only take on more debt unless absolutely necessary. And if at all possible, as part of your savings plan, pay down that debt. And then 4, prepare your finances. That really is having a realistic understanding of the home that you can comfortably afford, not the mansion out of the gate, but the home that you can comfortably afford. And last but not least, be ready. You said jump on. In a competitive environment, it's incredibly important that prospective buyers get pre-approved from a financial institution such as Bank of America, so that when they go in and make that offer on the home of their dreams or in the right community with the right schools, that the buyers see that they're ready, they're pre-approved, and that they can accept that offer.
I mean, Matt, my home buying strategy is similar to me going to Topgolf. I'm just swinging for the back net every single time. So hopefully I can heed a little bit more of your advice and prepare for something a little bit more reasonable out of the gate here. For a lot of home buyers, just lastly, while we have you, it seems like their home affordability or the home affordability equation also factors into a lot of who their pick for president might be, but almost flipping that on its head. Even once we get post-election, does that change the home buying sentiment for people depending upon who's in the White House?
No, I don't believe so. I've been through many cycles with whether it's a Republican, a Democrat, or ideology changes. Ultimately, that homeowner is going to think very similarly, and it's all going to be based upon their perspective picture financially, what they hope to achieve, and then the environment that we're operating in, more so than the political nature of who's in the White House.
Matt, really solid insight and context there. Matt Vernon, who is the Bank of America head of consumer lending. Matt, thanks so much for the time.
All right, thank you, Brad.
Coming up, the new federal student loan interest rates are out, and they are at their highest in over a decade. So what could it mean for students who are applying to school next year? That's coming up. Going to college is about to get a little bit more expensive. The Department of Education is out with their newest federal student loan interest rates for 2024 and 2025, and they're higher than they've been in over a decade, with federal undergraduate interest rates coming in at 6.53%. That's up from 5.5%. For more, let's bring in our panel here. We've got Christopher Gray, who is the Scally by Sally founder, and Mark Kantrowitz, who is the student loan expert and author of How to Appeal for More College Financial Aid. Mark, let's start with you. I mean, you hear a jump like this. What is this doing in terms of the affordability arguments for a lot of prospective students out there, and how could it alter their decision of where they go even?
Well, the 1% increase in the interest rates is roughly about $5.50 per $10,000 borrowed in monthly payments over a 10-year repayment term. So it's an increase in college costs, but not a huge increase.
Okay, and so Chris, for people who are trying to offset even the increase that Mark put into perspective here a little bit for us, where might this kind of be offset in the process of just looking for scholarships or looking for aid and applying for it?
Well, I think that people should start looking for free money for college, like scholarships, before they even start taking out either federal or private student loans. And there's even the FAFSA, and I know that, there have been some issues with that this year, but still just be patient. Like, figure out how much free money you qualify how much free money you qualify for before taking that debt burden, and that's obviously what Scally is about. But, I think that people should really look at free money first, because, the interest rates, it's increasing, and I think it's going to hit a lot of underserved communities even harder than most. So I think just making sure that you know what you actually need to borrow is really important.
Mark, there was an absolute FAFSA debacle even before some of the deadlines this year. As we're thinking about the number of students who are looking out to next year and trying to get ahead of their college selection process, how is what's taking place this year going to change the mindset for prospective students?
Well, the interest rates on federal student loans are set on an annual basis. It's a fixed rate for the life of the loan. But each year there is a new rate. And if the Federal Reserve starts cutting interest rates in the fall, then we could see the direction in which interest rates are headed reversing next year. And it's based on the last 10-year Treasury note auction in May. So there's a possibility that this might be just a one-year thing.
Chris, I saw you nodding your head even as I was mentioning that question, and what we saw take place with FAFSA. Do you think that we have reason to believe that there's going to be a material difference next year when this same deadline comes around?
I think that this is new, and I think anytime the Department of Education or any government entity tries to do something new, it's harder, and it's a lot of change. You're trying to do something for all American, over 44 million borrowers and things like that. So I think that hopefully by the end of this year, I do think the kinks of this new FAFSA will be streamlined. And again, like the interest rates aside, I think that process being, getting that together is going to be really important. But I do think that hopefully this will be a one-year thing, because it's caused so much chaos that I don't think that, and you look at, in addition to these interest rates rising, I just don't think that the government kind of wants that smoke. So I think they're really going to make it an effort to learn from this, streamline it. And I think ultimately once it's done, it'll be, the FAFSA is going to be much easier than ever.
Mark, when we talk about the college experience, it's a return on investment calculation that a lot of families and individual students calculate to understand what the return on their degree is going to look like. And we've talked about so much upskilling or reskilling in the existing workforce. How is that showing up among some of the college majors that are being decided on from what you've seen?
Well, you should aim to have your total student loan debt at graduation less than your annual starting salary. If total debt's less than annual income, you can afford to repay the student loans in 10 years or less. We don't really have a student loan problem right now so much as a college completion problem. Students who graduate generally are able to repay their student loan debt. But if they drop out of college, they're 4 times more likely to default on their student loans, and they'll struggle to repay their student loans. They'll have to use extended repayment or income-driven repayment to afford those monthly payments. So if they choose a major, maybe focus on one that can help you pay the bills after you graduate.
Chris, a similar question to you with the addition of course, generative AI, and I say it partially because that's the reality of what a lot of students are perhaps considering could be an applicable type of realm to get into, whether it's computer science or something else. And I say it partially for the SEO once this transcript posts as well here smartly. But at the same time, how many of these new majors are kind of inclusive of some type of generative AI understanding and being able to skill students for the jobs that haven't even been created yet?
Yeah, I think that the beauty about AI is that it's all built on data sets, right? And I think universities do have that, tons of course content. And I think that is going to make being able to train students on these different skills a lot easier. And I think that, and hopefully making these courses more affordable. I think making online education more affordable, online degrees more affordable at a cheaper cost. So we're thinking that that's kind of where we're going to see things. But I think that, yeah, generative AI is going to play a huge role in upskilling, reskilling, and actually being able to constantly adapt to skills, whereas universities and boot camps and such have to constantly go to humans to kind of change and update that curriculum. And I think AI will be able to do that faster and hopefully make these training more affordable and more accessible at scale to a number of people.
Gentlemen, thank you so much for taking the time here today. Chris, great to see you. Chris Gray, Scholarly by Sally founder and student loan expert. Mark Kantrowitz. Mark, pleasure to see you as well. I've been following your work across Twitter or X, whatever we're calling it these days. So good to have you on.
Thank you.
Thanks.
Thank you.
Coming up, everyone, we explore how you can play in the ETF space and protect yourself from market volatility. That's right after the break. Stick with us. Markets seeing green across the screen today after the consumer price index, known in your hood as the CPI. That report showing inflation moderated in April, but overall, it's been a volatile year here. There might be a way to protect yourself from some volatility in the market, and as part of the ETF report brought to you by Invesco QQQ, joining me now is Matt Kaufman, who is the Economist head of ETFs. Matt, great to have you here with us today.
Brett, thanks for having me.
Absolutely. All right, so here's an interesting way to approach ETFs, and there is one that's offering an inflation hedge. Walk us through how that's possible.
Sure. So this is a series of ETFs that offer 100% downside protection. And then
that sounds unreal. So you're going to have to walk us into that.
I understand. It sounds like magic.
Yeah.
We'll talk about how it's not.
Okay.
We'll lift the curtain back here.
Okay.
So 100% protection to an equity market like the S&P 500, Nasdaq 100, or on file with the Russell as well, Russell 2000. And then you get the upside of that market to a cap. So there's no free lunch here. You're getting capped upside, which right now in the S&P 500 is around 9 to 10%. So you get the upside of the market over a 1-year outcome period with no downside risk over that outcome.
Okay, and we were just taking a look at the chart and how this order essentially, or this ETF, would be executed. Can you just walk us through here the layers of protection as well?
Sure. So we construct this with a portfolio of options positions. There's 3 options layers. So the first one is to create your exposure layer, create the exposure to the S&P 500. The next is the protection layer. So we're buying a put to create protection against the market.
To the downside.
Downside, that's right. Yep. And then the upside, we're going to sell off some of your upside exposure in order to pay for that protection. And so we're selling off some of your upside opportunity to the tune of you get the upside to 9, 10%, and then you get the downside protection all in a single package. It all expires on the same day, and that's all inside an ETF that will never expire. The ETF will stay open. You can just stay in the product. So every year, you're going to get a new outcome period that you can invest in.
Why would someone consider this versus just a normal ETF, a basket of securities that perhaps is thematic or tracking up against a sector that they have a long-term investment thesis for?
Sure. So as you said earlier, this gives you an opportunity to outpace inflation. So we were talking earlier about taking care of your family, having money saved for a vacation. It's like that might be short-term money where you want to put that aside. You don't want to lose your principal on that money, but you want to potentially grow. So that might be an area where you can outpace inflation while you're holding that for maybe a family vacation. But then for longer term investors, you get into retirement. You think about the risks that retirees face. They're largely financial. You face longevity risk. You face outliving your money. Inflation risk is a large risk for retirees. So this gives you the opportunity. Think about getting 9 to 10% upside growth. That is significantly higher than the inflation rate today. So buying a product like this gives you the opportunity to be in the equity markets and outpace that inflation rate.
Is it something that's applicable across different sectors? So could you layer on an inflationary hedge or inflation protection across different baskets of securities?
Yeah, you could.
You could.
It's a good thought exercise. You could put capital protection today on multiple liquid asset classes. So we're doing it on the S&P 500. We launched that May 1st. Product has done very well. It's got quick adoption. June 3rd, we have a Nasdaq series, CP&J, and then Russell 2000 is scheduled to launch in July. And then we'll just keep going, one every month.
Matt Kaufman, who is the Economist head of ETFs. Thanks so much for taking the time here.
Thank you.
Absolutely. Guys, coming up, let's get to the grocery aisle here. Grocery prices still feeling the effects of inflation. We've got the CEO of Thrive Markets to discuss. That's next on Yahoo Finance. One real tangible way that consumers continue to feel the effects of inflation is at the grocery store. While prices are down from last month, they are still up 1.1% year over year. So what are some ways for you to save? For more, we bring in Nick Green, who's the Thrive Market co-founder and CEO, and our own Brooke DePalma joining us for the conversation as well here on Wealth. Okay, great to have you here in studio, first and foremost, making your way over from the West Coast to join us on Wealth. Let's dive into this. I mean, because we take a look at the CPI report and retail sales and really trying to get a sense of where this consumer stands right now, especially as it remains on grocery prices. What's the kind of broad stroke that you would annex to describe the consumer right now?
I mean, look, I'd say it's been 1% recently, but since the pandemic, it's been 25% plus. So people have gotten hit, they're feeling it. It's even more acute on certain kind of staples. And I think people are looking for ways to save. And in our case, for Thrive Market, we're providing healthy, natural, organic products, which are even more expensive typically. And so if you're committed to that lifestyle and you're feeling it in your pocketbook, you really need a way to get better prices.
Yeah, and what sort of ways has the average customer basket changed in the last years? They really think twice about where they're spending their money.
Yeah, I mean, we're seeing people go to those staples, right? Like there's a little less experimentation on new diets, new trends. They want to go back to the things that they know and are confident about. We're seeing them be more sensitive to promotions. So one of the cool things on Thrive, with our membership model, everything is always discounted from retail by anywhere from 20 to 40%. But then we also do these seasonal sales, thematic sales. And so at any given time, people can get those additional discounts. And we're definitely seeing our members go in bigger and heavier when the discounts happen. So AOVs go up, the staples, they buy even more of them. And then we're finding that they're also thinking about other types of incentives. So we've done stuff with our Thrive Cash offers where they get cash back, and members really love that. So, all the things you would expect when people are trying to save money.
What are the top selling items right now for Thrive Market?
Oh man, it's always been the core.
Yeah.
So for us, to give just a couple of examples, our natural, organic, single source, extra virgin olive oil. Comes in a beautiful tin. It's like super, super clean product, beautifully.
I did not expect you to say tin olive oil as one of the top sellers.
It's a good deal. Yeah.
Okay. Well, so if you send it in a bottle, right, it can break. And if you have olive oil in your order, that's no bueno.
Yeah.
So we make sure that can go and arrive to people's doorsteps well and save a lot of money on it. That's a staple. Yeah. We see on the supplement side, like collagen peptides, still part of people's regimen. We use a grass-fed, grass-finished beef source of collagen, which is sustainably sourced and very healthy. So that sells really well. But yeah.
Yeah, Nick, I do quickly want to hit on, you are one of the first and I believe only online retailers to give food stamps. Yeah. And that was a pretty big deal. I want to know, with that enrollment in February, how has your customer changed in the last few months?
Yeah, so look, we've always given very discounted prices to our whole member base. That's how it works. And every paid membership sponsors one for a low-income family. So they do have, there's a lot of low-income folks that are on the platform using our discounts. What Snap enables is for those people to actually use their EBT. There's 40 million Americans on EBT, so we're seeing an influx of those folks onto the site. They're more sensitive to savings, and now they can really get those.
Yeah, I do quickly want to hit on who are your competitors here, because we have seen Walmart, we have seen Target not only step up their online game, but we've seen them gain income cohorts across the board here. Walmart just launched that Better Goods. Target has Good and Gather. So how are you stepping up to compete with these big box retailers?
Yeah, I mean, look, we've always been out on the frontier of healthier products, more sustainably sourced, better for you. We're bringing products on earlier in their life cycle. We're giving better discounts with our membership model. Over a quarter of our sales are from our own brand, which you can't find anywhere else. So we really don't see those guys as a competitor. And we also don't see the premium health food retailers as a competitor, because those prices are way too high for most consumers.
What about your own cost inputs right now? I mean, Crunchbase has you guys in a range of $500 million to $1 billion in your own valuation. I mean, you could tell us where that leans towards if you'd like, but when you think about how you are monitoring this environment for your own expense profile as you're trying to make sure that, I don't know if a public debut is in the cards one day, but even if you do have to make that pitch to investors, that you are a healthy business that can withstand the test of time.
Yeah, I mean, look, we're really fortunate. We're doing over $500 million in sales. We're profitable. We haven't had to raise outside money for more than 4 years. So, we're in a really strong position to control our destiny, less focused on the valuation game, and much more focused on just continuing to grow, to drive that profitability up, to continue to do things that are differentiated. And when we serve our members better, whether that's through new products, new categories, better discounts, all those things drive the flywheel. And renewal rates for us are the name of the game, and we continue to see those increasing. We're really proud of the retention we have on our members, the word of mouth, which is still the #1 way that people learn about us. And if we can keep doing that, we got a long way to go. We have 1.5 million members today. There's tens of millions of people out there that want to get healthier. So we're just getting started.
Really quickly, in this environment where people are managing their average basket size, what are some ways that you're helping to boost that basket size? And is it AI that's helping to get more customers to add more at the end of the day?
Yeah, we've always seen larger basket sizes. So our average AOV, our average order value, has always been close to that $100 mark. And that's because we encourage our members to consolidate for sustainability reasons so that we're not sending onesie-twosies that have a big carbon footprint and a ton of packaging. So we've always had great AOV, but we have seen that go up, and we've been able to push it even further using, to your point, better technology. And using a machine learning algorithm, you can take the data inputs from what people have purchased in the past, even what the whole member base has purchased in the past, as well as an onboarding quiz that we do where people share their preferences. And then we help them to not only give recommendations, but actually load the cart. And what we're finding today is on that first order, about half of what people are purchasing are the things that we load into the cart for them. So it's been really cool to see that algorithm, that machine learning get better and better. And we absolutely see AI as a core pillar of the future of grocery shopping.
Nick Green, Thrive Market co-founder and CEO and Yahoo Finance's Brooke DePalma joining us here as well. Thank you so much for joining us in studio.
Thanks again.
Absolutely. Everyone, we got to do a quick final check of the markets here. We got about 15 seconds left. And taking a look at the Dow, the S&P 500, and the Nasdaq, we're in positive territory across the board. Nothing more to say. We've got a little bit more of the trading session left here. We're just hitting the lunch hour. That's it for Wealth Though. I'm Brad Smith. Thanks so much for watching. Plus, stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up 3 p.m. Eastern Time. You don't want to miss it.